This video is going to have everything you need to know about trading, how to get into trading, how to start trading, how to place your first trades, how to scale up, and how to actually make money trading. So no bullshit, let's just get right into it. This video is going to be like 5 hours long, but I promise you if you follow everything I say, it will make you profitable. If y'all don't know who I am, my name is Elder. I've been trading for 9 years now, actually 9 years this year. And these are my stats recently for the past couple of days, past couple of months. We'll go back as decently far as y'all want to. Now, keep in mind, I've been doing this for a long time, and every single trade you see on this little screen right here is all done live. I go live every single day at New York Open. I've not missed an open in a long time, and these are all results people see me take live, right? And this can go back pretty much as far as you want it, and we pretty much have been killing it thus far. So let's just get right into the whole strategy and the whole system, starting from the beginner stage. So if you're not a complete beginner, you can skip this part, right? Right now, I'm literally going to be telling you, this is for complete beginners, what we are even looking at right now, and make it super, super simple. This is a chart. You don't know what a chart is, I'll break it down in like 10 seconds here, right? What this is showing us, right? We have price on the y-axis. We have time on the x-axis. Hopefully you know what that is from elementary school education, right? Now, inside this is a chart that plots us where price was at what given time. So if you go back all the way on March 6th, at 9:30, where was price? Price was at 5,600, right? You can't see that. Let me close my screen a little bit. Price was at 5,600. So that's all it's showing me is price where it was and price where it currently is at, right? Now, the way it plots that makes it a little easy on us, right? We have different time frames we can select when you're trading, right? You can look at the 1 day, 1 minute. Now, if I click this, right, what this is showing me is 1 day. So this whole chart is 1 day, and each little candle, each little box that we're about to go over here very, very quick is 1 minute. If I go on to the 5 day, 5 minutes, it shows me a 5 day range, and each little candle is 5 minutes, right? Now, what is a candle? Make it super simple on you guys, right? Now, there's red and green candles, and this is a white candle, and I'll talk to you about what every single one of these candles means. So a red candle means that price during that time frame, so right now we're on the 15 minute, right? Each candle is 15 minute. So in this 15 minute time frame, right, price opened, this is a red candle, price opened at the top of the box of the candle and price closed at the bottom of the box. That is all the candle is showing you. Let me draw it out real quick for you guys so you know exactly what I'm saying, right? We have a box, right? Let's say this candle is red, right? And there's wicks. There's wicks on the candle. So what this is telling us is that price opened, if the candle is red, at the top, and price closed at the bottom of the candle, right? Open, close. That's what this candle is telling us. And the wicks are telling us where price was the highest and where price was the lowest. So during this 15-minute time period, the candle opened at the top of the box, closed at the top of the box, but the highest it was at this 15-minute time period was up here. The lowest it was right down here. So hopefully that makes sense for you guys. Every single red candle is the exact same, right? Now, the green candle is the exact opposite. The bottom wick and the top wick of the green, red, and any other candle is the same, as where price was the highest and lowest during that time period, right? But the box on the green candle is a little bit different. The bottom of the box on the green candle is the open, and the top is the close. So all the green candle is showing you is that price closed higher than it opened, so it's green, right? It went up. Red candle is showing you the price closed lower than where it opened, so it's showing you that it goes down. Very simple. This is easy stuff. Y'all should pick this up in literally a couple seconds. Now, this neutral candle is basically showing us what I just said, neutral. Price open and close exactly at the same spot, and it'll give you a neutral candle, guys. Now, enough with that. Let's get right into the good stuff. So we are going to start talking about theory. Theory is the number one thing, and it's really crucial to understand what the strategy is, why it works, and why a lot of things are bullshit, and why this one is actually following things that make sense. Because then when we talk about analysis and setups and all this other good stuff, it's going to be a lot different. It'll actually make sense to you. Okay, so the way we're going to actually break it down is theory. We're going to go over all the tools we use for analysis, and I'm going to help you build setups with these tools at the end. Then we're going to talk about risk management, psychology, everything you need to know in one YouTube video. So you don't have to search, go to different courses, do all this other crap. It should be all right here. So before we start, if y'all have questions, leave them in the comments, and I'll try to get to all of them as fast as I possibly can. But before we start, I got to get through the platform. So I use Thinkorswim, which is this right here. Then I use Quantower, which is this right here. Don't worry about this. You're not going to need to know about that yet. But I recommend y'all use, if y'all have a prop firm, I'll put everything in the description below. I'm not sponsored by them, just to help you guys out. Thinkorswim, TradingView, great for charting. Now brokers, if you're trading futures, right? If you're trading futures, I'll put this in the description below. You need to have a futures broker if you don't want crazy margins. So not Thinkorswim. You need Tradeovate, Ninja Trader, and futures, any futures broker, right? If you're on a prop firm and you have rhythmic connection, so go to Apex Top Step. I'll put, again, everything in the description. Pick a rhythmic connection, and then you can get Quantower. You can get this right here for free, right? What I have right here is also free. So 2 free softwares you can use. You don't have to pay for them at all. And then prop firms. If you have your own broker and you want to trade options, Thinkorswim right here is a great choice. Great choice. Not for futures though, unless you have bank. Crazy bank, right? So questions, put them down below in the description. Those are the platforms I use to trade. That's all it is. And I also use bookmap.com, which we'll go over in a little bit as well. So this is what we're going to be trading. So we're only going to be talking about futures trading short term in this little hours long video. Futures is going to be long term, right? So sorry, short term, options long term. So why it matters is these instruments are leveraged. So we're making more money for the money we put in. So if let's say we were to trade 1 share of SPY, right? SPY goes up $10, you make $10. If you're in 1 contract of SPY, 1 call contract, right? Expires tomorrow and you put $300, same thing as SPY, into that contract, or 500, whatever SPY is currently at, and it goes up $10, you make significantly more than you would. I'm talking about like $500 versus just $10, right? So that's why we trade these instruments. They are leveraged, which lets us get more money for our buck. But we could also lose more money. So it's important to know the risk, and it's important to manage risk correctly. We're going to go over all that as well. Again, if you're not a beginner, you can skip forward this video when I talk about the more advanced stuff, but we're breaking everything down here for you guys, everything. So what are futures? Future contracts are agreements to buy or sell an asset at a specific future date, blah, blah, blah. What they are don't really matter. So what I'm saying is when we go long, we can make money if the market goes down, right? When we go long, we're buying the asset to sell at a higher price, right? Buy low, sell high. When we go short, we borrow the asset, sell it, then look to buy it back at a lower price and then return it back to where we borrowed it from, pocketing the difference. Now, if that sounds confusing to you, good, it's fucking confusing. But don't worry about it because it does not matter. This is how you're going to trade futures, right? If you think price is going down right here, you press sell. That's it. You press sell. You think price is going down right here, sell right here. You're looking to target this level right here, and you put your stop loss up here. All you do, you press sell. And if you think the market's going to go up, guess what? You press buy. Nothing changes. You just 2 different buttons you press. So don't worry about borrowing the asset, all that bullshit. I'm just giving you a definition of what it is, but it doesn't matter. It does not matter, right? Again, we're just making money here. We don't care about the bullshit stuff. We're making money. Sorry about my dog. So if you're interested in trading either options or futures, here are the pros and cons. So again, if you're day trading, especially with prop firms, I would focus on futures. Much more beginner friendly, much more forgiving. Just focus on futures, guys. Sorry if my dog's going crazy. Doing construction at my house right now. I don't even know what's going on. I think they're doing a new kitchen downstairs that was supposed to be done, but they might go crazy here. But anyways, pros and cons. So futures, no PDT rule, meaning that you don't have to have $25,000 in your account to actually trade these futures. You could trade them with basically, if you have a futures broker, $500 gives you access to a lot of leverage. So in 1 contract, 1 mini on the ES, we'll talk about what those are. You don't need much money to trade futures, right? Or especially day trade futures. With options, if you have like a margin account, if you don't have $25,000 in your account, you can only take 3 day trades a week, which is not good, no bueno. So with futures, you can trade them 23 hours a day, 6 days a week, different sessions, right, all around the world. So you have more. If you have a 9 to 5, you can kind of work around that, right? The bid-ask spread is consistent, and what the bid-ask spread is, we're going to get very deep into what the bid-ask spread is, especially when we're talking about order flow, because it's super important. It's just basically what price the sellers are willing to sell for an asset, the price the buyers are willing to pay for an asset. That's pretty close, pretty consistent versus options that can have crazy spreads, right? Sellers want to sell at $100, buyers want to only buy at $50, so you get that crazy spread. No Greeks in futures, right? And it's simple. Options are awesome. I love options. Options have made me more money by far than futures, by far, just because I play them long term a lot, right? I run leaps, I run spreads. They're confusing as hell. Day trading them can be brutal. They can skip your shit. Spreads can be crazy. You can only trade them 5 days a week from 9:30 a.m. to 4:30 or 4 p.m. Sorry about that. They're great for swing trading though, because you can't swing trade futures unless you have a bank in your account. So options are great for that. So this video is going to be about day trading, but if you're interested in options long-term trading, join my free Discord down below. We talk a lot about that because it's great to make money day trading. You don't want to rely on that for the rest of your life. Reinvest that money in options plays, long-term option plays. Dollar cost average, just buy shares, man, buy dividends, and we talk about that a lot, just so you don't have to work for the rest of your life, right? So when to day trade options instead of futures. So if y'all are day trading options, that's fine. This is what I look for when I'm day trading options instead of futures. I want a clear market direction, right? I don't want to play in a chop. I want the IV to be 70%. This is too much for you. Don't worry about it. We'll break everything down as this gets deeper and deeper. And a tight spread, right? That's it. We're going to focus on futures, right? As I said, the strategy will stay the same for options, futures. Even if you're trading crypto, whatever else you're trading, the strategy will be the exact same. The only difference is with options, and I guess only options, you need to analyze the option chain, which if you want to learn about that, we can learn about that later. Not in this video though. And then tip, again, I talked about this. Use futures to make money and options to multiply it long term. It's the key here. It is the key and it is the way. So this is what I focus on. You can trade anything else you want, but I focus on 2 different pairs that I trade. That's it. Right, these provide me with enough opportunity every single day. I don't need any more opportunity. I don't need to look at 20 different things at once. Just these 2 things gave me the results that I showed you guys here, right? Just these 2 things, right? That's it, have given me these results on a daily basis, right? We actually have some weeks where we go in, right? 22K, 28K, negative 18K, right? You got to be prepared to hit those losses, 39K, 33K. We have not had a red month in a long time, right? November, pulling 58K, December, bad month. So the start of this year has been a little bit difficult, a little bit tricky, but we've been doing decently well so far. Now, this is basically SPY, if you're familiar with SPY, right? It is the future derivative of SPY, and there's option derivative of SPY, all these other derivatives. But focus on ES, which is a future contract. This is what it is, what's behind them, what the exchange is. You probably don't care, and neither do I. This is the leverage of ES. Now, this is important, right? Leverage of ES. So every dollar ES moves, you get $50 per your contract, per one contract. So we have a chart of ES here, right? Let's zoom into like the 5-minute. Every dollar, so it goes from 530 to 531, it's $50 you get per contract, but also $50 in the negative, right? If it doesn't go your way, if you place the wrong trade. So if you buy one ES contract at $5,000 and you sell it at $5,010, you just made $500. Simple, right? This is the margin requirement. This is what you need in your broker account to be able to trade one ES contract. If you're on a futures broker, which I recommended, I'll put them all in the description, you need $500 per contract. If you're on Thinkorswim, or any options broker and futures broker together, which is a lot of them, like Webull, Robinhood, Thinkorswim, the margin requirement is much higher. I think it's higher now than, let's see what it is right now. Yeah, one ES contract is 21,000 and one NQ contract is 30,000. You have that in your account to hold one contract. So that's why if you're trading futures on your own personal account, get a futures broker, right? This is the NQ leverage, right? We have $20 per move. That's it. And the margin is different right now, but only difference is every dollar NQ moves, you make $20. Right, not bad. And then why I trade ES and NQ, literally simplicity and the fact that I only trade the market open. I only trade New York open, which gives me enough opportunity. There's the most amount of volume, most amount of transaction on ES and NQ at the market open. So if you're trading a different session that has dead action, right? Maybe you want to trade gold instead. Maybe you want to try a different pair instead. So this is just personal for me. You can trade anything you want. This is the best thing that works for me. If you're trading New York Open, I highly recommend you look at ES and NQ, right? And again, pick only 1 to 3 tickers to trade. Don't try to trade the whole market. You're going to drive yourself nuts, right? Each ticker has its own personality. Learn how each individual instrument, ticker, whatever works, like the back of your hand, and then that's all you need to be a millionaire. That's all you need to make a lot of money. You don't need to trade 50 different things. I promise you that, right? Now the market session. So I trade, again, the open, right? Because there's the highest amount of transaction volume. The other sessions you can trade if you work 9 to 5, right? And this is all EST, 10 p.m. to 11 p.m., 3 a.m. to like 8 a.m. has a really good move because of London, all right? Now, we're going to talk about trading theory. We're going to get right into the theory right away. So the auction theory is what we're going to talk about first, and these theories are all about my strategy. So if you don't know the theories, knowing the strategy will be pretty difficult. So the auction theory lets me predict intraday movements, and it's based on level 2 data. Smart money concepts, a theory that was coined, I mean, this different name, same shit. Basically, it gives me the valuable price levels, and the areas of interest. Combining these two gives me levels where I want to take trades and entries for these trades, right? So it's very, very good. Now, the auction theory. So the stock market is like any other market, right? Like the real estate market, car market, whatever it is. It's an auction, right? So how we're going to understand the stock market auction is the order types, right? The volume by price analysis and aggressive versus passive orders coming into the market. So if that doesn't make sense to you, good. You'll learn everything about it in this video. Auction theory. So this is to put it in simple terms, right? The market will move up until the last buyer buys and it will move down until the last seller sells. So, you know, a quick example, like let's say Apple Store is selling iPhone for $1,000 and they sell out. They move price up to $1,500 and people still buy, but they don't sell out, right? People stop buying.
So what happens with Apple, right? People stop buying their iPhone at $1,500. They have to move price back down to $1,000 to get people to start buying again. And people stop buying that, simple supply and demand here. You learn this in school. If you stop buying at $1,000 and you lower down even more, if they sell out at $1,000, you need to pick it up even more. So that's how the market is controlled, right? If people are not buying at a high, the market will then reverse. Like just to show you an example on the chart. The market sells off, right? The volume dies off. People stop transacting. They must pump back up, right? Pump back up. Works great shorter term, works great longer term as well. Just analyzing volume real quick on the high. Like look at the volume that died off here until the market continued to sell off. Now the sell-off continued because what? Volume was picking up as price was moving down. Good transactions were picking up, so the volume or the price continued to move down, down, and down. This is one part of the theory, right? Very useful. Same goes with the stock market, right? Instead of iPhones, Apple stock. Apple price 200. No one wants to buy or sell at 200. Apple will then, or nobody's transacting at 200. Apple will then pick another price that is valuable, or people will come back in and transact. Very, very simple, guys. Now, the market's job, right? The market's main job, very, very important, is to facilitate trading and advertise price. So if nobody's trading at certain prices, it must advertise itself at a different price point to get people to come in and take trades and play the market. That's what the market is trying to do. That is the job of the stock market. So, and again, this is why this happens, right? This is why institutional traders don't use charts. They look at price and level 2 data. They don't care about charts. They don't care about where price is. They don't care about where price or any kind of chart patterns, indicators, candlestick patterns. They don't care about any of that. That doesn't matter. It's irrelevant. The market does not give two shits about that, right? And that's why you can go into any institutional, literally any bank, any hedge fund, any proprietary firm. You walk into there, and I promise you, they're traders right now, probably all algos. But in the past, and they probably still some out right now, they don't have a chart on their screen. They're not drawing support and resistance, trend lines. They're not even drawing supply and demand. They don't care. So you have to remember that and think like they do. So this is how I find price levels that smart players are interested in, right? So we talked about the auction theory. This is a little bit of smart money concept. So even a 5-point move in the stock market will take hundreds of millions of dollars for it to actually come in and actually move the market, right? So institutional traders make up 97, I think it's a little higher right now, 97.8% of the total market transactions, right? And this is how we know when they're active, when big moves in the market happen. This is how we mark down when they are active. Now, retail traders, us, anybody who's not a bank, hedge fund institution, make up 2.2% of the transactions. So that's why we stay away from retail patterns, chart patterns, candlestick patterns, lagging indicators, all that bullshit. It doesn't really work in the long run, man. And a lot of players, a lot of traders will be like, oh, they're stop hunting me, they're chasing for my stop. They don't care about you. The money you have in the market is so tiny that they don't care. They really don't care what you're doing. They don't care about you. They're not chasing your stop. None of that shit is actually happening. It's all bullshit. So we want to trade how they trade. We want to not how they trade because it's basically impossible because they have to trade differently because of liquidity. We'll talk about that soon. But we want to be able to follow the way they're going, not try to make up some bullshit patterns. So finding levels of interest, basically supply and demand. So we're going to look for significant moves up and down, right? I'll show you what that means as well. So we're interested in the price zone right before the significant moves. Basically, these are my supply and demand zones, right? These zones are where all the orders get filled, causing price to have that explosive reaction. So remember, big moves take a lot of money. So that's how we know where the big money sits, is when the big move happens. So, and this is one thing, right? This is one thing that is very, very, very important to remember. So big money has a huge, huge problem. Liquidity, right? Liquidity. So there's two sides to every transaction. So if a big bank wants to sell $1 billion of SPY, somebody has to buy $1 billion of SPY from them, or they can't sell it. Just logically thinking, right? It's just two sides to every transaction. This is what we're going to talk about later. This is where market manipulation and liquidity levels come into play. It's because for the big guys to actually be able to offload or get into big positions, they have to do some sort of manipulation in the market, no matter what it is, to be able to get filled. Because if they're selling $1 billion, like there's not going to be anybody on their side. It's not going to work, right? So they'll do icebergs, they'll do sweeps, they'll do front running, they'll do a bunch of different shit. They'll use news. A lot of them just use news, bro. They're literally, these fucking brokers are the news. They are the news, and this is how they run shit, man. This has been going on for a long, long time. It is unfair as fuck. Nothing can be done about it. Nothing will ever be done about it. So we're just here trying to take advantage of it. Volume. We love volume, right? Since there's no such thing as buy or sell volume, because remember I told you there's two sides to every transaction. So if somebody's buying, somebody's selling, there's no buy volume, there's no sell volume, there's just volume, right? That's all there is. So the way we know who's in control is by using the spread on the bid and ask, by using the order types, by using the relationship between passive and aggressive participants, right? We look at the volume of aggressive buyers and the volume of aggressive sellers to determine who is in control, right? Now you also have to combine that with the passive participants, which might not make any more sense to you right now, but it will very, very soon. So this is the spread I was talking about, right? The bid-ask spread. And basically when you're buying into a stock or you're playing a position, you kind of see you have this, right? Sell, when you're looking to sell, right, it'll always be at a higher price than the buy, right? Sellers always want to sell more, buyers always want to buy it less. So this is you have the sell right here, which is the ask price, the buy, which is the bid price. So again, they'll always be different from each other, right? A bid is the price that buyers willing to pay for an asset. The ask is the price that sellers willing to accept for an asset, and the difference between them is a spread. Why does this matter, right? And again, we talked about the futures have tight spreads, so the spreads don't really matter when it comes to futures. But we also talked about what the bid and ask is, right? The bid cheaper than the ask. An example on the ES here, the bid here is 5499, or the ask is 5499, and the bid is 5499.50. So 50-cent difference in the spread. So how we actually tell who's aggressive is with the order types. Combining order types with the bid and ask gives us who is being aggressive. So there's 3 types of orders in the stock market. We have the market order, the limit order, and the stop limit orders, take profit orders, all that kind of stuff. Basically the 2 major ones are market and limit orders, because stop orders are also limit orders, take profit orders are also limit orders. You have different bracket orders, but we don't need to know about that right now. Market orders, right, are filled at the current market price. They're filled instantly, and it's constantly changing, right? So you see how the I want to get into a market order. You see how the market is constantly moving up and down, up and down, up and down, right? So that market order is constantly changing. So if you get into a market order and you're wanting to go in long, you want to go for a buy, you're going to get filled at the ask. Because if you want to get filled in right there, right now, you'll have to buy from someone who's willing to sell right now. And those are the sellers who are selling at the ask, right? So you'll get filled at a higher price. And the same thing on the other side, right? So think about it as ordering lobster at a restaurant. If you go to a restaurant, you want lobster right now, right then and now, you're going to pay the market price, right? Whatever it is. But if you want to eat lobster, but you want it cheap, you'd be like, oh, when is it lobster season? I'll get cheaper lobster. So I'll wait till August to go to a restaurant and eat lobster there. You're paying the market price, but you also know that it's going to be cheaper at that time. So it's a weird analogy, but it'll make sense to you here in a second. So limit orders, again, we'll talk about that. These are the passive participants. So they're only going to get filled where the level you selected at, right? And they will not open, or they will stay open until filled or the market closes. You can set it to where it never closes. Don't recommend that. Very simple. If an investor wants to buy Apple at $100, but Apple's at 110, they'll have a limit order set at $100, meaning whenever Apple hits $100, they'll go ahead and take that position. So another example, right? If I want to buy ES right now, but it's too expensive, I only want to buy at 5516. I'll put a limit order right here, and when price hits that shit, it'll fill me. Easy as shit, guys. Stop orders are used to manage risk. They're basically limit orders. So it's only if I'm already in a position is how stop orders work. So let's say I'm in long right here at this price point, right? And if price falls beneath 5509, I want to get out. I want to get out, take my losses, and run away. So I'll put a stop order right here. So I'm in here. If price goes beneath this, it's going to stop me out. I'll get out of the position. And let's say I want to take profits. Right, I'll take profits. Let's say up here is where I want to take profits. I'll put a take profit order, limit order there, and if price hits this, it'll fill me and I'll get out of the position. Same thing, right? So these are the orders to control your risk and control your take profits. So who is in control? How do we know who's in control based on what we just said? So now that we know the order types, we know the difference between the bid and ask, we can use order flow to determine who is in control. So who is aggressive, right? What are aggressive participants? So remember, aggressive participants are the market order. So when an investor buys with the market order, when they're buying with the market order, they want to get in right now, it will hit the ask. They're buying at a higher price. They're willing to pay more for this asset, so they're being aggressive. When someone sells with the market order, it will hit the bid. They're willing to sell for a cheaper price, hence they're being aggressive. So the passive orders are all the limit orders sitting in the market, right? They're all the limit orders, stop orders, entry orders. These are the people who will trade only if price gets to where they want it to get. So now we have to learn how to read the relationship between both of them, right? So the market will move up if there's more passive buyers and aggressive sellers, and vice versa, right? Buyers are in control if there's more aggressive buyers and passive sellers. If there's more aggressive buying than there's passive selling, the market will move up. If there's more passive buying than aggressive selling, the market will move up. And it's just vice versa for the sellers. If there's more aggressive sellers and passive buyers, go down. More passive sellers and aggressive buyers, go down. It's a tongue twister, it gets confusing, but once you start to visualize all of this, which is why I'm going over the theory with you first, when you start to visualize it, use these indicators we have, use these tools we have, it'll make a lot more sense to you. right? So before we actually get into anything else, I kind of want to give you all a quick introduction. We're going to go over risk management more at the end, but it's important to not jump into trading, especially learning about analysis and everything like this without knowing what risk management is and why it's super, super important. This is should be step number one. The market does not care about how much money you're comfortable with losing. It does not care that you only want to lose $50. You only want to lose $1,000. It cares about price, and it only will ever care about price. This is a general rule of thumb. We'll get more in depth about risk management at the end of this video, but if you're in a personal account, don't risk more than 2% of your account in a single position. That does not mean your position size has to be 2%. It just means your stop loss level must be less than 2% of your account, right? So this is mostly to do with options, but let's say you have a $10,000 account, right, or a $100 account. You want to risk $2 per position, right, or a $10,000 account. You want to risk $200 per position. So that's it. Very, very simple general rule of thumb. On a personal account, you stick to this, and if your win rate's over 50%, you're gonna be chilling, right? With just a quick example, 10K account size, you're risking 200 per position. You found a long setup on the ES, right? Identified an invalidation level. We'll talk about invalidation levels at 4490. So for one contract, if you want to make sense for your risk, right, you must enter at 4494 or lower. So your risk is a little bit less, right? 4 points of risk on the ES with one contract is $200. Don't worry about that. It's too confusing for you. Just want to put that out there that risk is going to be super important no matter how good we are at trading. Managing risk is going to be key. So 2% per position. If you're in a prop firm account, general rule of thumb, I give people prop firm accounts. So prop firms, unfortunately, give you access to an insane amount of leverage. But your account size is basically your drawdown. So with a 50K account, you have access to 50K in leverage almost, depending on the prop firm. But you can lose only 2K before the account is blown. So you really only have $2,000. And if risk management is personal. It'll be dependent on your win rate and your account size. But a general rule of thumb here for your prop firm is account size is 50K, your drawdown is 2K. After losing 5 trades, you don't want to be below 50% of your drawdown, so you can only risk 200 per position there is what I would recommend for people to do. In your win rate, right? Talking about your win rate, how accurate a setup is. And this is very defined. Once we get to my setups, I'll show you all my win rates and you'll see how defined and how accurate it is, right? I'm talking about what's the sentiment of the market, right? What's the 4-hour trend, 30-minute trend, 5-minute trend? What is the price currently doing right now, right? Where is VWAP? Where is volume? Where's the volume at, high or low? Right? What is my entry trigger? What is the VIX doing? Everything has to be defined and consistent. That win rate matters. Your win rate, win or lose, if you're taking random setups on every given day, does not matter. It is so irrelevant that you shouldn't even be tracking it. It doesn't matter. So once you get your win rate, this table you can use for your risk to reward ratio to be profitable. So basically what we're saying is here, if your win rate is a 50%, every single trade you take, you must be risking a 2-to-1 and you will be profitable. What this is saying is the 50% winner, meaning half the trades you take, you win, half the trades you take, you lose. If you risk $100 to make $200 every single time, you will be profitable, right? Use this table. Again, market is all about probability. We never, ever, ever know. Don't try to predict or just don't try to be married to anything. We don't know what the market's going to do next. We don't know. We never will know, right? The only thing we know is we can control our risk, right? The best traders out there have probability slightly lean towards them in their favor, or they just know that what their favor is or what probability is. You can have a 10% win rate and be profitable. Very possible. It takes a lot of discipline and large mental capacity, but it's possible. And all that's left now is just managing risk, right? The example here is the coin flip, right? This is why it's a numbers game. You can flip a coin 50 times, and it might all land on heads 50 times. It might, you never know, it's probability. You can land on heads, probability has no memory. You can land on heads 50 times. Now you flip that coin 10,000 times. You flip that coin 50,000 times. It will be very, very close to 50-50. The more times you flip it, the closer and closer and closer and closer it will get to 50-50. That is how trading works. It's a numbers game. So we will continue risk management when we actually start to review setups, right? I'm going to get a little ahead of myself here, but don't worry if this gets confusing. We're talking about orders, aggressive orders, passive orders. So right here, this is the way I used to read it, right? And it's a footprint chart, right? It's showing me the delta. So this literally will show you exactly how many more aggressive buyers than there are passive sellers. So all the offers on the right side are all the aggressive offers hitting the ask, aggressive buyers. The left side are all the aggressive orders hitting the bid, the aggressive sellers. The delta will plot the difference for you, right? And it'll even give you the volume per candle. So you can see all the aggressive buyers. You can see all the aggressive sellers. These aren't things I just made up. You can actually see them, right? And right here, we have a Bookmap. What does this Bookmap show us? All the passive participants. It gives us the exact number. This is a multiplier right here on the order book. But this right here is showing us all the passive orders. Right here above price is all the limit orders that are sitting there, right? So if we want price to go above, and keep pushing up, we need more aggressive buyers. Are these green circles? Aggressive sellers are these red circles. So you can actually see these in real time. You can see all the aggressive buyers. You can see all the passive sellers. You can see everything, right? Very, very useful, right? Here again, what do we have here? A bunch of aggressive sellers, but we have more passive buyers than aggressive sellers. So the market moves up. If this makes no sense to you, if this looks crazy, good. You're going to learn all about it in this video. So do not worry about it, guys. This is what we're going to be using. And it looks crazy, looks confusing, but it's very, very simple, right? Very, very simple. Right, here's a good idea. This is what happened here, right? We see all this positive delta, all this positive buying pressure, the market does not move up. Why? Because there's a bunch of passive sellers sitting right there, absorbing all the aggressive buying, and the price then moves down. Very, very, very important, guys. All right, so we're going to get right into technical analysis. Now, this is a beast, guys, because now we know all about the theory. So now we can learn about the tools we use to analyze the market based on our theory. Very cool. So probably my most favorite part, even though this might be kind of boring, but this is none of this is boring to me. So key levels, right? We have, and again, my strategy that I trade is simple, and I very, very much enjoy keeping it simple. I think every strategy should be simple. It's based off of key levels, so based off of market structure, based off of volume by price analysis, and order flow. These 4 things is all you need to have a very, very juicy strategy. So the key levels, right? Supply and demand are my major levels. I will not trade outside of these zones. And then liquidity, which we talked about a little bit, right? Can be used as an entry if it's in supply and demand, but if it's not in supply and demand, I'll use it as a take profit, and it acts as a magnet. So then we'll go over that a lot as well. Supply and demand. Quickly, we're going to go over what these zones are, how to draw them, and this is basically where smart money has shown interest. So the time frames we're going to be using for these zones: 4 hour, 2 hour, 1 hour, 30 minute, and sometimes a 15 minutes. I'll show you why the 15 minute here soon, but it's kind of rare that I use a 15 minute. So what you want to do first is look for a big move up or down, right? So we're looking for one big massive body candle, or a couple, big body candles to medium size that continue. So right here, let's just go ahead and draw a couple with you guys. So we're looking for big moves down and big moves up. So let's start off with supply. So what supply is, right? We're going to start on the 4 hour chart. Identify the big move down right here. And then identify either consolidation or a neutral candle before the move down, right? And then the top of the zone is going to be the top wick. And the bottom of the zone is going to be the bottom body of the candle. So we're going to do one for you here, or a couple for you, so you get this down. We're going to repeat this all the way down to the 30-minute chart. So quickly, you see this, right? You have a big move down. What do you see? Right here, we have consolidation before this big move down. So the top of the box is going to be the top of the wick. The bottom is going to be the bottom body. What do you see right here? 1, 2, 3 candles moving price down pretty significantly. We have one neutral candle, and a neutral candle is just where price open and close around the same area, give or take, 3 points on ES, like 5 to 10 points on NQ. Just a neutral candle. Y'all know what neutral is. Big wicks, small body. Now, again, top wick, bottom body. All right. Let's just go ahead and draw one on our own here too. So we're going to go all the way over to the 4 hour chart. We're going to find big, massive moves down. So there's a bunch. Let's just pick this one for supply and this one for demand. Now, what we do after that, right, is we go on to the 1 hour chart. You can go on the 2 hour, but just for the sake of this video. Now, what do we see on the 1 hour chart, right? This zone still holds. This zone can now be made a little smaller. All right, you see it swept that, consolidated. Usually old zones will turn into new zones. This one's still good. We can just kind of adjust that just for these 2 neutral candles right here. Put that there. What do we see though right now? On the 1 hour, right? We see another zone form right here, but we're not going to worry about that one for right now. We jump all the way down to the 30-minute. Just clean this up a little bit more. Right here, looks good. This one actually now on the 30-minute, I want to expand it a little bit because we have this consolidation here, not just on the 1 hour. And I usually leave mine at the 30-minute, and I'll sometimes go to the 15-minute, very rarely, and I'll show you exactly why. 4 hours is the same thing, but for demand, it's backwards, right? The bottom of the zone is going to be the low of the wick. The top of the zone is going to be the top of the body. So just flip-flop that. So right here, where's our demand? Bam, right? The 15-minute zone. So this is something I will use, like for instance, if the move down is just huge and there's no zone or 30-minute in between, you want to see kind of if there's anything in between. Let's just say there's like a huge move down to the chart, kind of the example there. Like let's say we're on the 30-minute here and we just see a massive, let's see if we had anything recently, a massive move down without any zones. So maybe something like this, massive move up, massive move down without any zones in between, because we're going long here. We want to see what's the next thing coming up. What you have to do then is drop into the 15-minute time frame. This is only if it's a super, super wide area. and see if you find any zones in between. So on this long side, we didn't see anything, but now on the 15-minute chart, we see this that wasn't here in the 30-minute, and we'll go ahead and mark that level, right? Super, super cool, super, super simple, easy to use. Nothing too crazy about that. So that's the only reason I'll use the 15-minute guys, myself back up there. Now, market structure. This is the next thing that's very important about analyzing the market. So there's a balanced market structure where buyers and sellers agree on price, just consolidation. Bearish market structure where the sellers are in control. Bullish market structure where buyers are in control. Very easy. In a bull market, right, we have something that is easy to use and identify a bull market. It's the way I look at it is 3 higher highs, 2 higher lows. I look at the 4-hour time frame, how I determine my sentiment, right? And if we have a bull market, I want to go long. I want to go long off long off demand, or wait for a break of supply and retest to go long. The market's bullish. You want to follow the trend. The trend is your friend. Go long. Bear market, the opposite. We want to go short off supply, break retest of demand. 3 lower lows, 2 lower highs. So I use the 4-hour structure to actually base my sentiment. It works the best for me. And obviously right now we're in a very, very clear bearish market sentiment. Extremely clear, right? Because of all the shit we have going on right now. So balanced market will look like this. 3 equal highs, 3 equal lows, 4-hour consolidation. We're in a balanced market. And if we're in a balanced market, I want to play both sides. I want to play longs at the bottom, shorts at the top. Not in between. Don't play in between the range. And this is the goal for the sentiment. We're looking for the fade, a nice little fade, nice little fade. We want, so just for the best chance of winning, right? We want to fade the 30-minute into the 4-hour. Now, what I mean by that is if the 4-hour is clearly bearish, we want to look at the 30-minute and find any 30-minute uptrend, right? Any 30-minute uptrend into supply to fade. We're looking to fade the 30-minute chart into the 4-hour chart, right? So these look ugly, but you see what I mean, right? If the 4-hour is bearish, you want to look for a 30-minute uptrend into supply to fade. And again, into supply, we're going to look for those key levels. So a bear fade, right? We're looking for an uptrend on the 30-minute chart into supply for shorts. Bull fade. For our bear market, right? For our bull market, you're looking for a 30-minute downtrend into demand for longs. Going against structure. Now, sometimes it's okay to go against structure. What I do personally, if I'm going against the 4-hour structure, or if I'm going against a fade, is I size down, or I wait for the 5-minute chart. So let's say the overall market condition is very bullish, and I see a very nice action on the tape here in supply. I would get a pump up. I wait for the sell-off in supply. I wait for structure to shift. I want to see sellers step up and be aggressive. I wait for us to come back up, and I'll take my entry here after seeing the confirmation first. And these are the different market sessions you can use. Now, the sessions will affect the instrument you trade, and we're going to use these sessions for liquidity, which we're about to talk about next. So again, if you're trading gold, you probably, actually gold is good for a lot of sessions. If you're trading ESRNQ, you don't want to trade like at a random time, like right when the market opens up at like 6 again, or right when the, at like fucking 11 p.m. at night. It's going to be super slow. You want to trade those good hours. So if you have to trade off of work, trade a different instrument. Liquidity. Now we're going to talk about liquidity here, and it's very, very important, guys. So we're going to talk about session lows and highs, right? These lows and highs are very, very valuable for these big guys, because this is where a lot of liquidity is resting, and this is where a lot of their orders usually are sitting or are being placed. So most of the liquidity is going to be equal highs and lows, but not equal highs, session highs and lows, but there's also going to be a lot of equal highs and lows that are counted as liquidity. So pre-market is marked, so this is the Asian London session. I marked at the same level. Some people like to do it differently. I'll mark the New York and then the Asian London as the same level. So this black box right here is the New York, and this gray box is the London and Asian session. So I'll go ahead and show you exactly what those times are. So you're, let's highlight this so you're not confused. So the New York market here, the futures market will close where this little line is here at 4, turn out at 4 at 5, then it'll reopen back up at 6. So New York, this area, I look for the highs. I look for the lows. I look for the highs of the New York session. Then pre-market, right, overnight session, I look for the highs and I look for the lows of the overnight session. That's how I get my liquidity levels. And then if we have equal highs or equal lows, which will go over here, I also mark as liquidity, right? So basically what I just showed you here, equal highs right here actually. This is the equal liquidity. The more actual equal touches it has, the stronger it is. As you can see, like touch here, touch here, touch here, touch here, and then when it actually swept above, it flew right down. So equal highs and lows do act as liquidity as well. Now, the next thing we're going to show you is the volume profile. Now, this can be used on any platform you want. I'll link down the ones I use below. I actually have this indicator customly encoded or embedded on Thinkorswim the way I like it. So let's go ahead and clear all this, and we'll talk to you about the volume profile. So that's this box we have right here. And it might look confusing, but it's really not, man. This box just shows you a day. It shows you the total day. So right when it closes to right when it opens, it gives you the day of the market. So now, understanding what these things are is simple. So the gray histogram, which is this little histogram you see right here, right in between, shows you the volume, right? If I zoom in significantly here, I think we can actually see, even see the numbers it has. Let's see, which I don't use it for that, but I think you can. Where'd it go? How much did I zoom in here? A lot. There she is. So I think if you zoom in, oh no, never mind. You used to be able to see the numbers in there, but you can't. It literally is just showing you the number of volume at any given price point. So in the middle here, you see there's a lot on the histogram, a lot of volume. Up top, there's dead, no volume. And then the blue box is the basically the value area. So it's just the price area with the most volume. It's 68% of the most transacted volume that day will be plotted with this blue box. So here you can have a tight value area, here it had a wide value area. And then the yellow line that you're seeing is the point of control. This is the exact price point on the chart, right? With the most volume. So this is showing you where there were, again, who are the big players, right? The ones who trade a lot of money. This is showing you the exact price point where there was the most amount of money traded, which is why it's super important to perform volume by price analysis. And the way you perform this analysis is easy, right? So you can use volume profile analysis to find the trend of the point of control, just basically meaning, is the most amount of transacted volume on every given day going higher or going lower? So in this current bear trend we were seeing, right, what is going on with the current points of control? Almost every single day, we're seeing lower and lower and lower points of control, meaning that we're transacting at high volume at these lower prices, right? Meaning the market will continue and continue and continue to go down. For gap ups as well, just determine a quick shift in structure, but no, a quick example, gap down, gap down, gap down. Point of control continuously going down, 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 just confirms a bearish sentiment. Instead of just looking at just candlesticks, right? Confirms a bullish sentiment. And then also, when you see a bunch of points of controls that are very close to each other, aligned very, very nicely. I like to look at the 30-minute for points of controls, guys, but when you see them very, very nicely and aligned, it presents a very, very good level, especially if it matches up with the supply and demand zone. It usually makes it a ton stronger, and the accuracy of that actual setup playing out in your favor, it goes up a lot. Now, something that I use the point of the volume profile for on the 30-minute chart is the VPOC, right? And this is a line. If this line is untouched, so the point of the day closes and the point of control is untouched, it becomes a version point of control. So if the next day or the next couple of days price comes up and taps that point of control, it usually indicates a very, very strong reversal. So any strategy I'm taking, if there's a point of control, a volume point of control at that level, it increases the win rate significantly. Now, quick example right here, I have a point of control that was untouched. 2-3 days go by, price touches that point of control, sells off significantly. So it's very, very cool indicator to use, very, very strong with all the other confluences as well. Now the volume indicators, these volume bars that people use, this actually represents the level of aggressive buying and selling, not the total volume, because there's no such thing as buy and sell volume. But it can be used for drawing zones and it can be used for volume profile analysis. So if you can just look at these bars, you see volume dying out as we're getting to demand. You see interest dying out. It's great to actually go for some positions. Even kind of zoomed in a little bit. Let's say you had demand down here, right? Price was coming down, falling into demand, but as it was falling down into demand, you see volume start to have a little downtrend. Good indication price might reverse. Now, for volume by price, these are the tools we're going to use and talk about later, right? We have footprint charts, we have Bookmap, and then we have volume bars and the volume profile. I talked about some of those already for you guys, but basically what we're going to use these tools for a bounce, we want decreasing volume. For a breakout, we want increasing volume. Simple, right? Right here for bounces, what do we see in the volume profile? Volume die out, right? Right here, when price reverses, what do we see on this consolidation and supply? Volume die out. So if we're going for a bounce or reversal, we need to see volume die out for that to actually work. The next thing we're going to be talking about here is VWAP, right? And VWAP is actually used by institutions. It's very, very well respected. And for us, it's a take profit level. These are the settings I currently have on VWAP. It's this yellow line here. So if I go ahead and switch to my execution chart, style, I have the VWAP here, right? So that means if I'm short here, I look to get out of VWAP or take profits at VWAP or leave some runners after VWAP. If I'm in long here, I'm getting out of VWAP. That's what I use it for. Take profits. Now, next one. So to quickly recap before we get into a little bit more of the level 2 data, right? We have the bid price and the ask price. We talked about that, right? We have the order types, limit, passive, market, aggressive. Remember that. So for level 2 data, right? We're going to be talking about a little bit more complex stuff now, right? This is going to show us the behind the scenes. This is going to show us all the offers hitting the bid. This is going to show us all the limit orders, the stop orders, the quotes, the spread, right? The tools I'm going to use and show you guys the footprint charts and Bookmap. You can also use the depth of market, level 2, and times and sales. Now, the tools I showed you with those little bubbles and those crazy candlesticks, right? They're the best way to look at it, because some people, I used to do this, will watch the level 2 and we'll watch the times and sales. Now, this gives us the same data that the Bookmap gave us. That gives us the same data as the footprint chart-ish gave us, right? But it's much more visually appealing. So that's why we're going to be focusing on the footprint chart and the Bookmap, my two favorite ones. Doesn't matter what you use, to be honest. I'll give you the same data. But let's hop right into Orderflow. So Bookmap. Start off with a nice little bit of the Bookmap. Basically what this is, right? The green bubbles we saw will give you all the market buy orders hitting the ass, the aggressive buyers. The red bubbles, opposite, aggressive sellers. Now the bars, right? If the price is right here, I'll tell you where price is. If these bars are above the current price, they're sell orders. If they're below the current price, they're buy orders. And for me, the way I have it set up is the more darker the orders are, I have it set up like this is a scale. So the more red it is, the bigger it is, right? You can tell by the order book here, which gives you the number of orders actually sitting there, but it's multiplied by like 100, I think. So that's what they are. So just talking about the order book, number of limit orders, and you can, so the time frame for Bookmap doesn't matter. There's no time frame, right? You can just literally zoom in and out of Bookmap. There's no time frame for it. No, nothing like that. So don't worry about the time frame when it comes to Bookmap. So use Bookmap to read the relationship between aggressive buyers and sellers. So what you're going to use Bookmap for is only when we're approaching a key level, right? We want to look for huge amounts of passive orders. You want to look for aggressive buyers failing, or sellers failing to move price up or down. Trapped players, we're going to look for, if price moves up and there's more aggressive buyers and passive sellers, and like vice versa. That's what we're looking for. I'm going to show you exactly what I mean here. Let me go ahead and clear this Bookmap mumbo jumbo right here that we have. So absorption is a big term I use. So we talked about this example, buy side. So aggressive buyers into passive sellers, and market moves down, right? Sellers in control, right? This is sell side absorption here. Aggressive sellers into passive buyers, and market moves up, buyers in control. So we have a huge amount of aggressive selling coming into large amounts of passive buying. And what happens after they're done, right? Buyers are still left over. Sellers are not strong enough to move price down, and price continues to move up. And then we see buyers start to fill all these offers and move up, 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 and up, right? Very, very, very important to know here. And the next thing is who's in control, right? If aggressive buyers are filling passive orders and being rewarded, price moving up with them, they're in control. Meaning that if you're trying to go short, but you see all these passive orders or sellers coming above price, and buyers fill the orders, go above, fill the orders, go above, fill the orders, go above. You don't want to go short. You want to wait for that to die out, right? And then right here, you see a huge seller fall down. The biggest seller was down here, right? The price did not move down. Again, it filled more buy orders, moved up. Great for sentiment, great for entries, great for stopping you doing stupid shit. If the market's moving up and you want to know if it's strong, look at the Bookmap. Leftover orders are a pretty nice deal. I'll tell you what I mean about that. So if buyers and sellers fail to fill all passive orders, the market will reverse, right? If there's more passive buyers and aggressive sellers, the market will move up, and vice versa. Again, so right here, we popped into a big level of, again, passive sellers. Market does not fill all of them. There's some left over, right? So the market then moves down, comes into this big buyer, fills all the buyers, right? So usually when you fill the whole offer, you have a little bit of a tracement back up. But right here, I would go for a short. Right here, I would not go for a long because we filled all the offers. Meaning if price could easily now come back down and just reverse it. We don't even need aggressive sellers. It could just come back down and just reverse all that if it wants to. Right here, there's still some left over. So see the two big differences there. So you can use these limit orders. Like let's say you have supply and you see a bunch of fucking limit orders sitting in supply. You see price come into those limit orders, doesn't fill all the offers. Great indication for short, right? Now the delta, the footprint charts have the delta, but Bookmap is a little different. If you actually hover over the Bookmap bubbles, you'll get the volume of that bubble. Let's zoom in a lot here. You'll get the volume of the bubble, right? You'll get the bid. So if it's green, it'll give you the bid. If it's red, it'll give you the ask, and you just get the volume, right? So you don't get the overall delta like the footprint chart gives you, but it's still pretty cool. We're going to use these for setups, though. We're going to get into it. Let's go ahead and jump into the footprint charts. So for this one, we're going to talk about, again, we talked about the bid-ask offers. We're talking about imbalances and volume by price per tick, because footprint charts are really, really crucial for reading volume by price. So what we're going to look for in the footprint charts is big positive negative delta, trap participants, interest in higher or lower prices. We've talked about a lot of these, right? Now with what a candlestick is, obviously we talked about what a candlestick is in the beginning of this video. A footprint chart candlestick, right, will give us on the left-hand side all the sellers, all the offers hitting the bid, all the market offers hitting the bid. On the right-hand side, it'll give us all the market orders hitting the ask, which are the aggressive buyers. It would also give us the delta, the difference. So it adds up and subtracts all the aggressive buyers and sellers, and it gives us the delta. All right, so if it's positive delta in this candle, whatever time frame you have, was 1,600 more aggressive buyers and sellers, and this candle was negative 1,400. So that means there's 1,400 more aggressive sellers than buyers. It also gives you the volume per candle, which is pretty cool. Now, absorption, right? So usually for absorption on the New York Open, is the time I'm trading on these candlesticks. If I see 3,000 positive delta and price does not move up in a 3-candle combination, I want to go short because that's massive absorption. It's just basically big delta without getting rewarded. So you're seeing all these buyers aggressively buy at buy price, buy, yet the market does not move up. All it's telling you is that there's a lot of passive sellers absorbing all those aggressive buyers, and the market then starts tanking, right? Big difference here. 3 candles with positive delta. No, had a sneeze there. 3 candles with positive delta, and the market does not move up. Then you get negative 2,000 delta, moves down. Negative 2,000 delta, moves down. So you see sellers get rewarded versus buyers not getting rewarded and getting absorbed. You can also look at it for sellers or buyers getting weak, right? So you look for, you see price moving down from 900 delta to negative 59 delta to negative 58 delta. So sellers die out, then bam, big buyer steps in. Very, very crucial. Volume dying out per wick is awesome, right? Because you can not only see the volume per candle, but the exact volume per tick. So with the footprint chart open right here, right, we get to see the exact volume per tick. So remember the point of control in the volume profile? Each candle has a point of control where the most amount of volume was. So you can look at to see if there was dead volume in the candle, if there was a lot of volume on the candle, where's all the volume taking place? It's very, very crucial. So this will actually be an entry for us. Dead volume into zones is going to be a good entry. Not only do you get that on the candlestick or the footprint chart, it's easy to read as absorption, right? What we just kind of talked about. You see absorption, 8,000 positive delta, price does not move up, then you get massive negative delta and price starts moving down. Good absorption. Right here you get what? More positive delta if the market does not move up. These candles are red. So what is this telling you, man? If you don't get in short here off this absorption, you don't want to get in long here because you're seeing all these passive buyers or aggressive buyers that price isn't moving up with them. Another good thing about the footprint charts is the imbalances. Imbalances are really, really nice because you get the follow-through imbalances. So these the footprint charts I have that you can get for free on Quanta or any footprint charts will actually plot out these imbalances for you, right? There's continuation imbalance and inversal imbalances, which is just a divergence in vertical order. So if it's a buy imbalance, it's a divergence in all the offers hitting the ask. If it's a sell side divergence, it's a divergence in all the offers hitting the bid. So right here. And we will use these for actually a lot of setups. So let's say you got in short here, or you missed a short entry here, and you get an imbalance made here. You can use this for an entry later on, but it just gives you extra confirmation of who's actually in control. All right, so we're going to be talking about the setups now. We went over theory, right? We went over exactly what the strategy is, what is the theory behind it, what is the thesis behind it. Then we went over all the technical analysis tools that we use to actually be able to read the market, to actually put the theory into practice and try to understand what the market's going to do next, right? And then now that we have that, we're going to go ahead and building in setups. As I told you guys before, having a strategy that works in the long run has to be tested. And to test a strategy, you have to know exactly what makes it click, what makes it work, and it has to be consistent and testable. You have to be able to back test this through years and years and years of data, so you can confirm, you can have the mathematical statistic that this strategy will work over a long period of time. Not only will it boost your confidence and help with your psychology, but it's also the only real way to make money in the long run and stay alive for that long. So that's why everything we're going to be talking about when it comes to setups is going to be consistent for every single trade. You're going to cherry pick the trades live in real time. That's what we want to do. So the must-haves for every single strategy we're going to talk about, right? Every single setup, every single strategy in the world, basically, that works has something to do with everything here. Market structure, understanding what the sentiment is, right? What is the current trend? Remember, the trend is your friend. Volume by price analysis, again, right? We want volume to be decreasing when we're looking for a reversal and increasing when we're looking for a continuation or a break. Risk to reward parameters, super, super key, right? That if one of these things isn't in check, it throws away the whole strategy, especially risk to reward parameters, right? Where your stop loss and take profit have to be according to your win rate. Entry trigger, we're going to talk about those in this section, right? You have to know exactly what will make you press that buy button or exactly what will make you press that sell button. And then the key price levels. So it gives you certain areas on the chart where you can take a trade, so you're not looking at every single inch of the chart, so you know exactly where there is some money active or they might step in again and sell off the market. So let's go ahead and jump Right into it, right? We talked about market structure. We know it's bullish, bearish, or balanced. So we need this step number one into our setup. So that's important when you come in to build a setup and taking a trade. Next thing is volume by price analysis, right? Reversal decreasing, breakout increasing. We got that checked. Entry triggers, these are the ones we're going to be talking about today. We'll also go over a couple more that I have here. A couple things I look for to actually get into a trade. All this other things make sense, right? A couple things I look to get into a trade are absorption, trap players, at volume push, liquidity sweep, balance range, fake breakout, aggressive follow through. All these things are telling me or signaling me, hey, buy right here, sell right here. The risk parameters, again, right? We'll recap this again. Win ratio. What is your win ratio? That determines your risk to reward and your position size. So if your win ratio is 50%, you need at least a 2-to-1 win to reward ratio, meaning if you risk $200, you better be making $400. If you have a 50% win rate, it will not work out in your favor. So you could back test or you can front forward test for your win rate, but you need over 100 trades. You need a lot of trades for your win rate to actually be legit. And you have to test in every single market condition, not just a fucking recession market or a crazy bull run or a choppy market. Every condition has to be tested for your win rate to actually be legit. And again, for your risk to reward, right? This is where your stop loss and take profit have to be according to your win rate. So for my setups, I only need mostly a 1-to-1. I go for a 2-to-1 most of the time, even though most of my setups are over 60%. But when it comes to prop firms, we already talked about this a little bit, right? If I'm wrong 5 times, I don't want to be over 50% of my drawdown. So with the 50K account, 2K drawdown, I'm risking $200 per trade. If I'm wrong 5 times in a row, I still have half the drawdown left and ready to go. And again, if you have struggling with blown accounts, blowing your funded accounts, treat your drawdown as a live account, right? Treat your drawdown as your account size, and I promise you, you'll stop blowing accounts. It's that simple. Just decrease size, stop trying to make money fast, stop trying to gamble, stop trying to get your accounts passed fast, build a consistent system, get good habits, and trust me, the money will come. Stop loss, right? And this is on invalidation. We're talking about how I place my stop loss and my take profits real quick before we get into the setup. So on invalidation of thesis, that's supposed to say thesis, right? On a new high or low. And something important here, right? The market does not care about how much money you want to lose. The market only cares about price. You'll see what I mean here very, very soon. So what I mean by stop loss, right? So if I got in long at 5572, if I think the market right here is going to go up from this level, where is my stop loss? If I think the market's going to go up, obviously if we make a new low, my thesis is incorrect. So I put my stop loss, there's my entry. I put my stop loss right at the previous low we made. If we go to that previous low, I'm out of that long position because the market is probably not going to go in my favor, or my thesis originally was to the upside, to the long side, right? I got in short at 55.80. Where's my stop loss? Right above that high, literally right up there, or the market swings back up there, makes a new high. I'm out, probably not going to keep going down. So sometimes I'll put my stop loss like a tick or a point, above the invalidation level, depending if I have either a big limit order sitting right here. If I got in short at these 82s, you gotta see a fat amount of orders sitting here. I'll put my stop loss right above those orders just to give me some more room. It also determines your risk to reward ratio, right? If I got in and my risk on invalidation is already way more than I want it to be, I'm not going to move it up. So depending on the scenario, and if there's limit orders sitting up there, other things like that will also be disgusting, right? And then let's move on to here. So the take profit level is same thing based on price and market structure, right? So for me, most of my take profits are at VWAP, but upcoming supply and demand if they come first, previous high or low, an EMA level, big limit offers on the Bookmap, anything that could cause price to reverse is where I want to get out potentially. But for me, it's mostly VWAP. So I'm in short here. Where are my take profit levels, right? Well, VWAP, obviously number one. Where's my next take profit level? That previous low we just made, right? That last low we made, right? And if we keep going, if you have runners, you keep going. This is how you do your take profit levels. So let's say I'm in long right here. Where's my TP level? First swing high. Where's my next one? Next swing high. And it just keeps on going. Remember, risk is trump. Trumps everything. No matter how good the setup looks, if your stop loss and your take profit do not align with the risk to reward ratio you need it to be, you cannot take the trade, right? That's why your entries are key. So if I need a 1-to-1 every single time to make this work out in my favor, and I identify a long position here, yet I'm risking 6 points to make 5 points, I'm not going to take the trade because the risk is too much. No matter how beautiful or how good the setup looks, risk will trump everything. It's the number one most important thing. That's why before you get into any trade you take, every trade you take, understand how much money you're going to lose if you are wrong. And you're going to be wrong a lot. I'm still wrong a lot. It's part of the game. But if you accept the loss, if you accept exactly how much money you're going to lose before you even get into the trade, it'll help your psychology greatly. So we cannot control risk, right? We can't control the market. The invalidation level won't change. Take profit level won't change. The risk to reward ratio won't change, right? What we can control is our position size and our entries, or entry, or exactly where we enter, which is the most important part. Where are we getting into, right? Where is the entry trigger? So position size, for setups over 60%, I will risk more than setups 50%. Just like blackjack, right? If you meet a player who gets kicked out of casinos because they make millions of dollars playing blackjack, you can count cards. When the count is in their favor, they bet more money. When the count is less in their favor, they bet less money. Same thing when it comes to trading for me. If I have a higher chance of winning, I'll put more money. If I have a lower chance of winning, I'll put less money. That's how I manage my size for most of my trades. For me, 50-60 is a big difference. Big difference. So some things for me that make it 50 versus 60%, right? The constant will always be the key level, the entry trigger, and volume by price analysis in the longer time frame. But A+ setups are with the 4-hour trend and the 5-minute structure. So the trend is very important here. Depending on what entry trigger it is, it does make it A+ versus A-. Sorry, my dog went crazy there. But A- setups, right? They'll be against the 4-hour trend. Pre-market setups for me usually drop to 50 against the 5-minute structure. Or when there's red folder news, I don't trade, but no news Fridays or Mondays usually for me have really bad price action. So I kind of put that into the A- category where I just size down on no news Mondays or no news Fridays. I don't trade red folder news, so that's something as well that negates my setup. I guess my win rate for red folder news is 0 because I do not trade red folder news, right? So let's go over some setups, right? We have the supply bounce, right? This is one of my setups. Again, all the entry triggers will be different. So what this means is we're in a supply level, right? Volume has to die off as we approach supply, so less interest as we make higher prices. We need to see an entry trigger, which we'll talk about later, right? It has to be with the 4-hour trend, and this win rate is honestly a recent win rate. It's not for the overall combination, just for the current condition we're in. 5-minute structure shift, and if there's a VPOC that we talked about, it adds like 4%, almost 5% to the setup, right? If this is all in favor, the supply bounce will have a really decent win rate. You need it 1-to-1 every single time, and you'll make money long term. So let's just go over some examples, right? In the zone, 30-minute supply right here, twice, right? Volume by price. Volume is decreasing as we approach, let me move my face. Volume is decreasing as we approach supply. What's the structure, right? What is the structure for the short? The 30-minute is bullish, right? 4-hour is bearish. So 30-minute right here, bullish structure, 4-hour is bearish, and the 5-minute has some structure shifts for both of these entries that we're talking about. And the entry trigger, for this entry trigger right here, it was absorption off the top on this consolidation. We're talking about the entry trigger. For this one right here, it was aggressive follow through, but as you can tell, the 5-minute, if you didn't take the position here, right, you get a new low made, 5-minute structure shift comes in, you can take the short right here. Or right, if you didn't get in short here, you get a nice new low made here into a lower high, and you can take the trade here off the structure shift, right, to get that win rate even higher. The next one is a demand bounce. So this win rate is actually for last year. We're in a nice bull market. But again, it has to be in the zone, right? It has to be demand. Volume has to die off as it approaches the zone. Less interest as we make lower prices. We have to have an entry trigger with the 4-hour trend, 5-minute structure, and the VPOC has to be on our side, right? Let's just go ahead and go through an example of what an A+ setup was today. I'll show you the setup I took today, actually. Pre-market, we had red folder news after the open, so I didn't trade after the open. I traded pre-market today. We go on the 4-hour. What's the sentiment? Very bearish, right? Now, what's next? What's left to do? Find supply levels. This was a 4-hour supply I traded today that as you get smaller and smaller got better, right? Find supply. So zoom into the 5-minute where I executed. Let's go ahead and actually include the VWAP so you can see where my take profit level was. So the market opened around here, right? As you can see the crazy moves up and down. There was news, there was data, stay away from that. We're pushing in to supply. What do we see as we came in supply, especially right here? See buy volume die off, right? And volume in general die off. So as we saw this come down, I waited for price to pull back down. So I didn't want to go short right away because we're getting good buyers, right? So I see buyers pull up and sellers actually step up first. Whenever these sellers stepped up, which is pretty aggressive on the Bookmap, you can tell by these candles right here as well. I waited for this consolidation, these equal highs to put my stop, because again, hey, I want my stop to be an invalidation. So if this is not a lower high, my thesis of going short is incorrect. And I took profits at VWAP. This is a trade actually we took today live. And the entry trigger here in this consolidation is just simple buyer exhaustion that we're going to talk about later, right? So it's simple. You can replicate this on the daily basis. It's not hard to do. It's actually very easy. So a quick example of the demand bounce, right? In demand, what's volume doing in demand? Dying off, right? What's the structure? What is the current market structure? So the 4-hour is in an uptrend, right? That's right here. 30-minute is in a downtrend right here. And the 5-minute shift to structure right here. So I'll talk about that. Entry was a liquidity sweep. So that's one of my entry triggers, right? We come back down here, we sweep liquidity, a good close, and go long all the way to VWAP, right? And this was before the 5-minute shift. The 5-minute shift happened after. Y'all can't see the sweep of liquidity. Sweep of liquidity right here from the previous session low, right? Where this demand was made. That was the entry trigger that we're going to talk about soon. Right? But this was A-. Why was it A-? Because we did not wait for the 5-minute structure shift, right? As this would have come back up and pumped to VWAP, would have made a new high, market would have came back down, and you could have taken it here and put more size down because the 5-minute structure shifted to bullish. That's very important, guys. A trend increases your win rate significantly if you follow it. Next setup we're going to talk about here is the demand break. This is just basically you're waiting for, or supply breakout. Sorry, you're waiting for supply to be broken. Bam, aggressive volume, and then after it's broken, you're waiting for a retest. So basically it turns into demand after it's broken. Because usually supply turns to demand, demand turns to supply a lot of the times. So you need a zone break with momentum and volume. So you need aggressive buyers present on the break. So if you look at the footprint chart or a volume profile or just something, you need a lot of volume present on the break of the zone. You need the candle to close above the zone or below the zone for the breakout, right? We need big momentum candles, right? Small wick, big body candles on the break. We want increasing volume on the break. It has to go with the 4-hour trend, with the 5-minute structure, and then when it retests, right? Now you switch it over. Now the supply becomes demand. You want dead volume on the retest and you need an entry trigger. That has a decent win rate as well. All right, key level right here. This is the key level. We just broke through supply. Volume by price. What did volume do as we're pumping up to supply? It's increasing. Volume is increasing as we're pumping up through supply. Right? What did the footprint chart look like? Right? We had, again, from 15K to 51,000 volume and 1,800 positive delta on the break. Good. Increasing volume, really good delta. Candle on the 5-minute. Let's look at the structure. 4-hour is bullish. 5-minute is bullish. Usually the breakouts will always align with the 5-minute structure. 30-minute is bullish. Perfect. Right? Retest. When we retest, we come back down here and we see dead volume start to come back into the zone, right? Dead volume. The volume picks up when we get the buyers that's actually stepped up, right? So the entry trigger here was a false range breakout. Usually when there's 3 equal lows and a candle dips below and comes back in and closes above the range, it's a very, very good opportunity to come back and test the top of the range or potentially go for a breakout in this case. So that was the entry trigger here. And again, very, very easy, right? We get that 5-minute candle right here, close above the zone, right? Or the 5-minute candle right here, sorry. Close above the zone and we get the retest, and it's a very, very nice retest, very, very nice entry trigger for the move up. Now this is just demand breakout to the other side. So these are for shorts, right? Everything we just talked about here, the same thing, but just on the other side. Quick example here, right? We broke demand aggressively, right? What's volume doing as we're breaking? Increasing. Aggressive break, right? So we're waiting for an aggressive break. So this break right here would not have counted for me, right? Because the wick and the body are pretty much the same size. This candle comes in and breaks aggressively, a good close, big body, big wick. So now we wait on the retest back into the zone, right? That's what we're doing. So what's the structure saying, right? Broke through demand. 30-minute is shifting to bearish. So the issue with this one is the 4-hour is bullish, super, super bullish. So what do? It's A-, we drop size. And the 5-minute always will align with the breakouts as bearish. The retest, volume died off on the retest right here, as you can tell. And the entry trigger on this consolidation was absorption that we're going to talk about. And then, again, all the A- setups we're going to talk about, right, against the 4-hour trend, against the 5-minute structure, they're not really A-. For me, it just means I drop size because it goes from 60 to 50%, and I'm less confident in the setup, so I drop size. During no news Mondays, no news Fridays, or anything like that, right? Same thing for all of these. Same thing. All right, so what is going to be next, right? Now we know how to find our key levels. We know how to identify market structure. We know how to read volume by price analysis. We know how to find our invalidation level and take profit levels to actually get in and out, know where to get out, know where to get in trades. The next thing is to talk about the entry triggers. And these are some entry triggers that I use. And it could be anything for you as long as you have data to back it up. I'm going to go over a couple you can look at. When I go over some of these, don't try and learn all of them and memorize all of them and go into the market looking for every single one. Pick one. Pick one little entry trigger. Master that entry trigger, and it'll be all you actually really need to get payouts, to get funded, to make money. I'm just going to show you some that I've been using, that I have used, that I backtest all the time. And when conditions shift, I'm adapting. I'm looking for better ones. These are always changing. I'm always learning, right? I've been in here for 9 years, and I'm always learning. The second you stop learning in the market, the second you stop making money. So let's go over a couple entry triggers. These are the win rates for these, right? And these are percentages for this year, by the way, guys. So that's why some of them will be like, what's the crazy one we have here? 92%, right? That's just for recently, because this entry trigger has not showed up a lot, but when it has showed up, it's paid off significantly. So that's why it's so high. Absorption, sweep, trap players, continuation, dead volume wick, or balance range breakout. Excuse me. We're going to talk about every single one of these. Now, there's a lot more I use. I have other videos on my channel, other videos on my free Discord, my free course about all of these. But these are the ones that work significantly well, easiest to teach and learn in my opinion. If you want to screenshot this, pause it here to look at the win rates for them, you go ahead and do so. So delta is something big that I will use for a lot of entry triggers, and that's what we see on the footprint chart that we showed y'all. So I'm going to use data from Quad Tower, Bookmap, Tradeovate, Thinkorswim. All of these get the same exact number of delta. I'm going to share with you a little typo there. And they will be related to the New York Open. So for conversion, the number of delta I'm going to give you is for the time session I trade, which is accounted for by the average volume during that session. So if I'm looking for 3,000 delta in New York Open with this crazy volume, I'm not going to be looking for 3,000 delta in the overnight session when the volume is like a tenth, right? So to convert it, if you're trading a different session or a different instrument, for pre-market, I cut the delta I'm looking for in half. So for different sessions, what you need to do is get the average delta per candle and times it by 2 to get absorption. So go back a couple days, couple weeks, get the average delta per candle, and it's going to be different for every single session. But once you get the average delta per candle per bunch of weeks, a bunch of months, and then you get the average of that, that's what you need. And it's hard work. Trading is hard work. This is what is required for you to do to make money trading. It's boring. It sucks. It's a lot of work. But this is what you need to do to make money. You don't need to look for another strategy, learn another indicator, entry trigger, get another mentor, watch another course. You need to just do the shit that nobody wants to do. Backtest, 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 backtest. Get screen time, practice. Stop looking for the golden egg. It's not out there. It does not exist. You know, like that Kung Fu Panda movie where Po finds the scroll at the end, whatever the scroll was called, and he's like, it's blank, it's empty. It just shines a picture of him because it was inside him the whole time. That's how it is with trading. It's inside you. You don't need to look or search for anything else. It's inside of you. Trust me. First one we're going to be talking about here is absorption. So this is consolidation, supply and demand. This one's very, very easy to actually identify because we're going to use a footprint chart. You can use Bookmap, whatever you want. But what we're looking for is 3 candles of consolidation, right? Equal highs in supply or equal lows in demand. And the distance between these equal highs or lows, 3 points in ES, 6 points in NQ, give or take, right? And the average delta of these candles has to be 3,000 plus. I shouldn't have put average delta. It should just be delta for shorts. It should be positive delta for longs. It should be negative delta, not average delta. We'll talk about what that means in a second. 3K plus on ES Open, 1.5K plus on New York Open. And for pre-market, it's half. Again, double X the average. If you have any questions about this, just leave them in the comments or join my free Discord and ping me there, right? And again, the entry for this is going to be in the close of the third consolidation candle. Now, if there's on the Bookmap, this is an extra. If I see big passive players not completely filled when I'm looking at absorption, I'll actually size up a little bit. Quick example in supply here. Right? We have 3 equal highs on this buy side, and then the absorption, again, well over 3,000 of absorption here. So whenever this third candle would close, I'm in short. Cherry pick, cherry pick, cherry pick, cherry pick. Right? For a break retest, break, right? You get absorption from sellers. Oh, you can't see it. Break, you get absorption from sellers. And what? There's some limit orders that did not get fully filled. So I size up a little bit, right? You get the 3 candles, equal lows, massive absorption. There's a 3K negative delta over that. Did not get filled, so we're in. So now we're going to be talking about the liquidity sweep. This one's actually beautiful, right? Beautiful. Really easy to identify, really easy to do. If you combine this sweep with absorption, you're in for a treat, bro. This is like close to 70% right there. So we're only going to be looking at session highs and lows, right? We're going to go for a sweep high / low. So it has to go above the level. So we taught you how to mark liquidity level. So the sweep actually has to go above the level. It can't be equal. If the liquidity level is at 50.25, it can't go to 50.25. It has to at least go to 50.5 for this to count. It has to go above the level and close back below in the 5-minute chart for shorts, and then opposite for longs, right? And if we sweep a high with 1K positive delta on ES Open or 500 plus delta on NQ Open and close above or below that level, I'll show you an example so it makes sense. The win rate increases by 6%, which is pretty decent for the time period that we're looking at. So let's just go over a quick example here of the sweep. See if I can find one just by surfing around, hunting this, see if we can cherry pick. Let's just go ahead and clear all this drawing set here. So let's just see if we can find any liquidity levels that got swept recently. And there might not be, right? This might not present itself too often, but when it does present itself, the market's been very trending. It works really well in the balance market. But when it does present itself, it's very, very valuable because it works a lot. So this is a good example right here, guys. Let's zoom in. We have marked out the overnight session low, right? This was in demand, I think. Yeah, demand from the previous day. Had overnight session low liquidity level. What happened with price? Sold down. What did happen when it sold down? We see dead volume coming into play. What happened, right? It went below the level, came back up and closed above. That's all I need to see. Below, close above, dead volume in demand. Against structure, so it's A minus. Whenever that closes back above, I'm in. I'm in whenever it closes. I put my stop right at the low and I target VWAP. It's that easy. It's that easy. Just do this over. You're not going to be right all the time. You're going to lose a lot. That's totally normal. But if you risk 2-to-1, or if you get that absorption of 1-to-1 every single time, guess what? You're going to fucking make money, right? It's a game about numbers, probability. So sometimes the risk will be too much on the close. Sometimes it won't. don't chase. For the example I just showed you, the risk is great on the close, right? What is that, like 3-4 points? Great risk. Sometimes, for example, we could sweep liquidity like this right here. Swept it. It's on a longer time frame, but a good example. Swept it and closed all the way down here. You think I'm taking that risk up here at invalidation? Fuck no. Don't move your stop. Invalidation level is going to stay here no matter what. Don't fucking move that shit. Just if the setup looks great, but the risk is too much, what do we say? Risk is trump. Don't take the setup. Easy peasy, right? This right here, look how perfect that sweep was. Close below, great risk. Put your shit right up here, and then bam, go for VWAP. Liquidity sweep with absorption will just look like this. Is when you see on the sell side it sweeps liquidity, and then you get negative at least 1,000 on ES on the open and half of that on NQ, and it closes back above. I just add more size because that is a very, very, very nice look for me, right? The next trigger we're going to talk about, probably the last one. I have a bunch, but these are probably the only 3 y'all need right now to actually be decent at trading. So price must be at the low or highs of sessions. So trap player longs, we'll talk about that first. Price must be at the lows of sessions, right? We're looking for negative 2K delta on ES open, negative 1K delta on NQ open. The sellers or sellers have to be in a 3-tick range from each other because it is a long. Price can't go 2 points on ES below the seller and 5 points on NQ. Instant rejection or pullback. So it's a very fast entry trigger here. I'm going to show you some examples. This is for pre-market and NQ, so usually we look at 1K, but pre-market we look at half. You're gonna get a one. This is only, you can use on Bookmap as well. I'll show you a Bookmap example, right? So we need at the very, very bottom of the ticks. This can't be in a wide range, right? For NQ, it has to be in a 3-tick range from each other. So it's gonna be a one participant, and this is usually this is a trap participant, we like to call it. So let's say this is in supply, volume works out, sentiment works out, everything looks great. Now we're just waiting for a trigger. We push down into it's supposed to be a long, yeah. So we push down into demand. Sorry, so we're in demand. And then we get this on the very bottom of the wick, right? 500 pre-marketed in Q. This is a trap participant. Price will instantly reverse with them. So if I see this and price pushes up right away, I'm instantly in some longs right away, right? The trap participant. On the book map, it'll look like this. If you hover over it, this is negative 2K on ES at the low of the day, and price instantly reverses it. So I'm in long right away. Now this is based on the theory, right? If a participant gets in, this is a big participant, like hence the 2K I'm looking for. Remember, this is all multiplied, so that's millions of dollars. They aggressively sell at the low of day, and they instantly get put pressure against them. So that pressure against them will force them to get out of their position slowly, which will then send the market even further in your direction. Because again, if you think about how the market works, it's not retail traders versus the big investors. If it was that way, like there'd be no money for the big investors to be made. They're playing against each other. These algos are going against each other. So when the trap player is identified and you see pressure against the trap player, he's going to get rewarded instantly, because when someone sells millions of dollars aggressively like that, it should move down in their favor, especially if there's no limit orders instantly. When it doesn't, it's an indicator, a trigger for me to get in, especially or only if it's in demand and if it's against the structure, if I see volume dying out. All the other things work out for me, I'm taking this position right away. Something that's very important to remember, guys, is, we can't change our stop. We can't change our take profit, our risk to reward parameters. We can only change our position size and our entry. So too much risk, wait for a pullback. If you miss an entry but see a setup, wait for the pullback so the risk makes sense. Size down if you miss an entry but the risk to reward ratio still works, right? The stop is so wide, you size down. So remember, very, very, very important. An example of that would be, let's say you get on this sweep here, right, and you miss it. So you miss it, it goes up with that. You still want to take the trade. Let's say VWAP is still 2 to 1 away, but the stop loss, the size you use. Let's say you usually trade 1 mini. Stop loss is 5 points. You're gonna lose $250. But let's say your daily loss limit is $200 or $100. Too much risk. So what you do is you can cut your size by half. So you have a wider stop, but as long as the risk to reward is still a 1 to 1 or a 2 to 1, you can do that. Good for it. If you miss a setup, size down. Better than chasing and having a stop loss that's not invalidation. Way, way better. So the next thing you have to learn how to do, right, is make a pre-market plan. Now that you have the triggers, that you know how to do everything, right? You have to make a pre-market plan every single day before the market opens, which is why you can't wake up, 5 minutes before the open bell and expect to make money. You can't. You have to wake up, plan for your day, and then when the market opens, you execute. Trust me, it's every single time you follow your plan, it's going to work out much, much more in your favor versus not having a plan. So the first thing you have to do is identify the bias, 4-hour trend, 30-minute trend, 5-minute trend, and volume by price analysis. Identify key levels, supply, demand, and liquidity. Look for red folder news, right? CPI, PPI, unemployment, FOMC, Powell, JOLTS, holidays, anything. Look for those news. Trump's big right now. He's moving the market like crazy. So I have his schedule up and I have his tweets up every day I'm trading, just in case something fucking big happens that can send the market going crazy, which it has been doing recently. So once you have all this written down, you then start to build your pre-market plan. For a quick example, pre-market plan, right? Let's say it's 8 a.m. We're up looking at the market. marked our levels, did our shit. Now we're going to write down our plan. Write this down. Like, don't just think about it. Write it down every day. If you're not writing it down, you're not going to make money. I'm going to say it straight up. Write this shit down. We currently have a 4-hour bear market. A 30-minute trend is to the upside. 5-minute trend just shifted to bearish. We're also seeing volume die off at the current price level, right? So we have a 4-hour bear market. The 30-minute trend is to the upside, right? We do have a bullish 30-minute trend. And the 5-minute trend just shifted to bearish, right? This is the 5-minute trend right here. 30-minute to the upside. 5-minute is now shifting to bearish, making lower lows and lower highs. So we're opening up in supply at 5586 with liquidity level at 5586.25. We have no red folder news today. If price sweeps above the daily high at 5586, I will look to go short into the 4-hour trend and the 5-minute trend. 5-minute, 4-hour line. We're getting that fade, 4-hour to 30-minute fade, and we're looking for the liquidity sweep at this high. Repeat that for all scenarios, right? So let's say if the market sells off, I'm gonna be looking for absorption and demand to go long. Since the 4-hour structure is bearish, I might want to wait for a break of demand and a retest to go short. Write every single scenario down. Every single scenario down. Have discipline to only follow your plan. Do this for 1 month and you're never gonna go back to fucking improvising. It's crazy how important it is to follow your plan every single day. If you don't have a plan, that's why you're not making money. Follow your plan every single day, and trust me, money will be an outcome. All right, now we're gonna get into a little bit of a psychological aspect of trading, right? We went over kind of these setups. We went over some entry triggers, went over what to look for, how to draw these levels, how to actually trade, how to get into it, what we are trading. The next thing we're gonna be looking at. Now, if y'all want videos on how to, set up your charting platform, set up your trades, all that kind of stuff, I'll link my free Discord down below. There's a bunch of educational videos in the Discord to talk about and break down a lot of the different things I did not talk about in this video. Very, very important. Emotional control matters in trading, right? Having a plan is the easy part. Following that plan is hard. So having the right analysis, managing risk correctly, learning how to read charts, that part is all easy. Following the plan that you have is the most difficult part about trading. It's why most people actually fail. So this is why it matters, right? So a lot of traders have different psychological issues. It really depends on where you come from, depends on who you are, depends on what issues or troubles you have in your everyday life, depends on where you're lacking, where you're not lacking. So it's different for everybody. We're going to talk about how you can actually find out what your issues are. It's pretty simple, and what you can actually do to overcome them and to plan for them, right? So quick examples, revenge trading, right? It's not accepting that losing is a part of the game. You cannot take being wrong. You're impatient. You have a short-term perspective. You risk too much money. So if you have a short-term perspective and you lose, you want to make that shit back, right? If you have a gambling mindset, you lose, you're going to want to make that shit back. If you don't accept that losing is a part of the game, every time you lose, you're going to end up wanting to make that shit back. Even if you risk more than you're supposed to, you lost more than you're supposed to, you're going to end up revenge trading and trying to make that shit back. Sometimes you'll make it back. More times than not, you'll blow weeks or months worth of progress in a single day because you revenge traded. Oversizing, basically the same thing as revenge trading, trying to recoup a loss, right? Let's say you size in with one contract, you lose, then you go the next trade, you go for 2 contracts, because not only do you want to make your money back, but you also want to make some on top of that, right? Trading is not linear. You're going to have to be okay with sitting in front of your computer screen for a long time, for hours, and potentially not making any money or even losing money. Now, when it comes to taking profits too early, this is one I actually used to do a lot. It basically just falls into having no confidence in your plan and watching your P&L too closely. I'll talk about what I did to overcome this, but one thing you can start doing right now is just removing your P&L from your screen. If you're watching your P&L too closely, you see big numbers. Especially if you're trading prop from accounts, or if you're watching big numbers go up and down, like you see $100 go up in profit, right? And it takes you 8 hours to make $100, for example. Let's say you work a minimum wage job and you see $100. It's very hard for you not to take that $100, right? But if you think about it in the long run, if your stop loss is at $200 and you're taking these short profits at $100, $150, you have a negative risk toward ratio. And in the long run, that will affect your trading profits. It will affect your account balance. It will affect everything. That's why taking profits early before you're predetermined to take profit is bad. Over trading is also a super, super big one. You're being greedy. You're trying to get rich really, really fast. You have no predetermined plan. You're basically just gambling. And that's one of the most common ones. Moving stops to a gut feeling, also like being married to your bias, having overconfidence in a setup. No set stop loss. You have a mental stop loss. So when price reaches this level, you're going to get out, but you would never end up getting out there. So you wait for it to go down and down. And you're like, oh, now it must reverse. Or you start dollar cost averaging. It just goes right in the mud. Don't do that, right? Before you get in the plan, you have to know exactly how much money you're going to lose and how much money you're going to win. And one of those two things has happened. That's it. Everything else in between is noise. It's either going to hit your stop loss or it's going to hit your take profit. Everything in between is noise. If you don't have a take profit before you get in the trade, that's one thing you can start working on right now. So big things to remember, right? We're human, man. We're not robots. We can't get rid of our emotions. It's not possible, right? We have to understand what we feel in real time, right? And then adjust our rules, adjust our plan to accommodate. So what I mean, if you're a fearful person, it means you're risking too much money, or you're unconfident in your strategy. If you're too greedy, it means you have too much of a short-term perspective. You're trying to get rich fast. And the revenge trading usually means you're addicted to gambling, right? Trading, especially when you're winning and losing, has a dopamine effect in your brain, and you can get addicted to that, and it's not a good thing. It can put you in a very, very deep hole. Journaling, right? Before you press buy, while you're in the trade, when it hits take profit, when it hits stop loss, journal your thought process, journal your mind, journal your emotions, and trust me, that's how you're going to pick up on triggers. We're going to talk about that soon. And you have to remember to have a long-term mindset in the market, right? Your next 100 trades matter. Your next 100 trade matters. Your current pass, your next trade are irrelevant in the long-term game. A big one to do as well for you guys is have a detachment from money, right? So remove the P&L from your screen. I already talked about that. Use ticks or points if necessary if you need something. Trade the charts, right? Go into every single trading day trying to repeat the process, be process driven and not make money. If your only goal, and this should be your only goal every single day, is to follow your plan and follow your rules, money will be a byproduct. You will make money if you stick to your plans and you stick to your rules, right? Confidence is a huge factor as well, guys. To be able to master market psychology, you need to have full confidence that your setup works in X amount of time, right? This is why a lot of screen time is required until we can read setups like the back of our hand. Because if you don't know the win rate, if you haven't backtested the setup you're trading over thousands of trades, you don't have confidence. But if I have a system that has been tested over thousands of trades, and I know it has a 50% win rate, and I know every single time I risk a 2 to 1, every time, I don't care how many times I lose, I can lose 10 times in a row, because I know in my head, if I keep doing this for the whole year, I will be profitable and I will make money. That's what you'll have to think about every single day you hop into the market. These are a little bit of my personal rules that I have, right? It's going to be different for everybody, but these are the rules I trade. 5 trades max per day. 3 losses max per day, right? If my first trade is a good winner, right around 10 points in the ES, 20 points in the Q, sometimes depending on my size, could be a little lower, I can only take A+ setups afterwards. I can't size up after 2 losses in a row. Won't do it. If I have a losing week, I will size down until I rebuild confidence. So if I have a red week, next week I'm sizing down until I rebuild my confidence, till I'm back in the green, till I'm good to go. This limits drawdown. I did this by looking at my data and noticing that every time I have a red week, it affects my psychology, and the next week I don't perform as well. So what did I do? I size down now every time I have a red week, and I completely get rid of that, right? This is how you're going to fix your psychological issues, by tracking, analyzing, and making a plan to be better. So getting out early is a pretty big one I used to do a lot. So very important thing to do is set a take profit on next reversal level and stop loss and invalidation level that we talked about in the previous parts of this video. So set your TP, get in the trade, set your TP, set your stop loss, and walk away. Turn your computer off. Make sure you have OCO bracket set up. That means if it hits your stop loss, your take profit will be canceled, because if you don't, it could hit your stop loss and go and hit your take profit, which instead of taking you out of the trade, it'll put you in a new trade, and it can be bad. I've done that before. Not fun on a real account. Cost me some money, but I've done it multiple times, way in the past, and I learned my lesson. Sometimes I made money off of it, got lucky, sometimes I didn't. So make sure you have that set where if it hits one of your offers, the other one is canceled. But get into the trade, close your computer, walk away, right? Do this for a month, and I promise you, your confidence in your strategy will grow significantly. And when I did this for a month, it was the best trading month I have ever had, and it really changed everything for me. Quick checklist that y'all can follow, that I follow, right? So remember, only trade the key levels. Pre-market research, right? Find key levels, volume profile. Write out your trading plan every single day before the market opens, right? Don't fucking go into the market without a plan, and remember to stick to your plan no matter what, right? Make sure your plan collides with your risk towards management plan. Can't speak. Start small. Size up when conditions get better. Check the economic calendar. Wait on confirmation. 5 trades per day max, 3 losses per day max. Let you look at this for a little second. Screenshot it. The next thing we're going to be talking about, analytical tracking. This is how you actually track your trade data. This is how you track your win rate. This is how you get better, and this is how you optimize your size. This is how you scale up. So this is how we're going to start tracking our analytical side, right? We'll do the psychological aspect a little bit later in this video, but this is what we're going to record, the simple basic stuff, right? The entry, where we got in, where we got out, the exit, right? Intended stop loss and take profit. I put TAC here. That's a little typo. Intended take profit and stop loss. What setup it was. What was your entry trigger and your R multiple. So a lot of people, right? Let's say you get in a trade, and this happens more often than not. let's just use this as an example. Let's say you get into a long right here, right? You intend to take profit is all the way up here, but you end up getting out here because you're scared. You get out early, right? Because you're scared. So what you need to track is not only where you actually got in and out, but where you intended to get out, right? Because let's say in this situation here, right? You risk $500 and your take profit was $1,000, but you got out early at $400 in profit. Your R multiple then will be negative. That means you risk $500 to make $400. And if you keep doing this, it'll fuck everything up. So you need to track this data. You need to track this information every single time you take a trade, right? And this is what your R multiple actually is. So R refers to the amount of money that you earn from a trade. So it's calculated by subtracting the entry price from the exit price, right? And dividing it by the risk taken. This is what the R multiple is. So for example, if you buy at $10, sell at $15. Your R would be, your R would be 15 minus 10 divided by 10. So it would be 0.5 or 50%. So R multiple stands for return multiple. It's just a measure of your risk versus reward. So it's calculated by dividing the reward, R, and the risk, also R, right? So for example, if you buy at $10, stop loss at $9, right? Your R multiple will be 15 minus 10 divided by 10 minus 9, right? So it'll be 5. So the difference between R and R multiple is that R measures the absolute gain and loss, while R multiple measures the relative gain and loss. This is super important because this is how you can determine if you're risking $500 to make $400, something's wrong. So your R multiple will tell you that. So it's very, very important statistic to track. In the description below, I'll put a software that I use. You can go ahead and open it up right now to actually track my trades. Let me log in. So this is for my challenge account that I'm currently doing, that we've been growing. Haven't traded it in a while, actually. Our last trade was on February, so I haven't traded this account in a while. But this will allow you to kind of filter out, right? Filter out everything you need to do. It will let you add in and import your trades. You can actually just link it to your broker and it'll calculate your R multiple for you, and it has a bunch of data you can use. So it's a very, very nice tracker. If y'all want to use it, I'll put it in the description down below. If not, you can just use a free Excel sheet. I'll put a free Excel sheet template down below you can use as well. Let's move on to the psychological tracking. Now, this is just kind of journaling, right? So when you're journaling, you kind of want to be very thorough. Your thought process before a trade, during a trade, and as it approaches your stop loss, as it approaches your take profit, and also after a trade. So why do we need to track all of this, right? So to understand what psychological factors impact your trading decision, if you understand them, right, you can add in rules to prevent these factors from actually affecting your long-term P&L. So if you have issues over trading or go on edge after each loss, so you wind up blowing weeks with the progress in one day, we can add a simple daily trade limit rule. A lot of people have triggers. Let's say, for instance, in the morning, right, you miss a setup because you're distracted or on your phone, or let's say you get wicked out and it goes straight to TP. That is a trigger that sets off people. That is a trigger when people have that happen to them in the morning, right? They blow weeks or months worth of progress based on that one thing that happened because they cannot control their mind. So what we do is set a rule. Keep a rule in place that every time you miss a setup because you're distracted, you turn off your computer and you walk the fuck away, right? Or you just size down significantly, right? Something has to happen because you can't trust yourself. Every single day you're gonna wake up and tell yourself, oh, this time it's gonna be different. This time I won't overtrade. But you've lied to yourself 50 times already. Why the fuck are you gonna believe anything you say? This is why accountability is important. This is why trading on your own is much, much more difficult. This is why having a community is huge. If you don't have a community, I'll put also my free community down below. It's free. You have people to talk to, people to keep you accountable, which is super important because you're not keeping yourself accountable. Stop fucking lying to yourself. You can't just fucking assume everything's gonna change when you wake up one day, because it is not. It is not gonna change, right? So again, we're gonna say this again. The analysis portion, the risk management portion, is the easy part about trading. The hard part is following your rules. What if I also told you you will only be profitable if you follow your rules? Many still fail to do so. Many have really good analysis. Many can read the market very, very nicely. Many are very good at winning, but they have those one day where they just go on tilt and they blow everything. Now, I'm going to say this a couple times. What you do off the charts matter, right? Are you physically fit? Do you go to the gym every day? Do you eat healthy? Do you have great relationships with people? Do you meditate? Doing everything I just talked about will show on the charts. If you're an undisciplined, lazy person who doesn't work out, eats like shit, doesn't meditate, has shitty relationships with your parents, with people, you're not going to be a successful trader. Trading is not only about the charts, it's about how you actually manage your mind, how disciplined you are. So if you're struggling on the charts, look at your everyday life, right? Start going to the gym, start meditating 15 minutes a day. That's all it takes, right? Start actually building decent relationships with people. Don't let trading overcome you. Don't let it put you in a hole of depression like it did me. And I'll talk about this at the end a little bit, but trading can get depressing. It can put you in a very, very, very bad spot if you're not careful. Now, I actually will give you a story that I've talked about a little bit before during my lives that I'm not ashamed to admit, right? When I first started trading, man, my parents didn't believe in me. My friends were laughing at me. Nobody believed in me, right? I was not partying. I was stuck in my room. I didn't have any friends. All I was doing was looking at charts, learning, taking fucking bullshit courses, trying to fucking pick shit up and actually try to make money. And for the longest time, right, I was working a job to fund myself, and all the money I was making from my shitty 9 to 5 that I hated was being fucking lost in the market. And that is a tough pill for most to swallow, right? You're working your ass off to make money, and all the money you're making working a shitty job is now being lost in the market. That's why most people fail. Most people cannot survive that. I was in a depressive state. I started taking antidepressant medication that made me suicidal. For some reason, the side effects of the depression medication I was on was suicidal tendencies, so it made me suicidal. I did things that I'm just glad I'm still here, to be honest. I wouldn't change my past. It made me to who I am today. But I feel like most people, because I didn't come from, a lovely childhood. My parents didn't have money. I was very, very poor. And because of that, I think I already had a strong mental fortitude just to be able to survive trading when I got into it. But many don't. And I just think about what if someone, who was in my position did not have the strength and went, and it was going through what I was going to, and instead of actually coming out the other side, they just took their life, which is not an uncommon thing. It's not uncommon. This happens a lot every single day, man. And which is why I'm trying my best to help you guys out. And I cannot stress this enough. It's not just about the charts. It's not just about the risk management. It's about your mind. You got to keep yourself healthy. I promise me that you will keep yourself healthy, because this could go down a very, very dark path. Have a community, have somebody, have a friend you're trading with. Don't be alone, man, because I was there. I know how it is, and it's not anything I would wish upon anybody, which is why when most of the people I'm with, most of my friends ask me, or just random people who know me, like, oh, should I get into trading? Should I do day trading? I tell them no. Tell them straight up no. It's hell. It's fucking hell, and not many people are strong enough to get through that and to survive. But if you're here, if you stood and you're watching this whole video, if you're serious about it, you probably are. If you stayed here and watching this whole thing, there's a light at the end of the tunnel, and it's gonna be fucking hell. And if you think you've already been through shit, trust me, you haven't. It's gonna get worse before it gets better. That's how it is with everything in life. So please just remember that. Now, backtesting is another super, super, super important tool y'all need to take advantage of, right? This is how I backtest, right? So you got to record data. This is how you get your win rate. This is how you adapt to new markets. This is how you practice. This is how you make new setups, new entry triggers, right? I trade level 2 data. So for level 2 data to backtest, I use Bookmap, bookmap.com. Thinkorswim, this platform right here, does have level 2 data backtests, right? And you can easily use it. It has good times and sales and good level 2, but it's laggy if your computer is not good or your internet is not great. Thinkorswim will not be good. It's a heavy platform, especially when you're backtesting on demand, right? All you have to do to backtest on Thinkorswim is press this button that you can't see right up here, right? You press that button and you're good to go. You can backtest on Thinkorswim. Very, very easy. Thinkorswim, Quantower, NinjaTrader, TradingView, all these platforms have replay mode, right? For candles and volume you can use to backtest. Sierra charts, Atas, I'll link all these in the description. There are also other good platforms you can use to backtest level 2 data and just normal chart action. So to backtest, what I do is picking the right time period is key, right? When I backtest, I'll go back to a similar 4-hour market structure condition. So the bottom is the current when this was made, and the top is April in 2024. So look how similar these conditions are. And I just go back and backtest to prepare myself for the week, almost every single weekend. Structure. This is how you can kind of run the backtest. So pause when you start your daily analysis. So you backtest, you go back to a day where the structure is similar. You pause at 7:30, which is from EST, which is when I start my pre-market analysis. I look at the news, draw my levels, make my plan. Then I fast forward until price hits my level. Then I go back to normal speed, find my entry, place my stop loss, place my take profit orders, and then I fast forward, and then I see if I win or lose, and I just repeat the process over and over and over again, right? It's simple. Make sure you backtest every single market condition. If you're doing this to kind of find a win rate or see if a strategy is worth it, you have to backtest every single market condition. Bullish market, bearish market, balanced market, highly volatile market, low volume market, high volume market, everything. Election period. I fucking went crazy backtesting election period markets recently because election period was just a whole different ball game for me, right? Now, let's go over a couple trade breakdowns before we go on to the next step of this video. And I hope you all have been enjoying it so far. Make sure to please subscribe down below and leave a like just so this video gets pushed to more people, right? Just so more people actually get a chance to watch this video and learn about trading and not have to spend money buying a course when in fact everything you need to learn is free on the internet these days, literally everything. So let's go over a couple trade breakouts. This is from a couple weeks ago, I think. I'm not quite sure the dates of when these trades actually came from. This wasn't last Friday. I know that for a fact. So let's go ahead and let's just get right into it. So this is a trade. I think this was like a couple weeks ago. So it was a nice trade. 4 R&R right on the NQ. So we'll talk about this breakdown first. So what was my pre-market plan? So every single day in my Discord, right, I post my pre-market plan. I talk about my bias, what I want to do for the day. So plan for the day, my red supply zone on ES and NQ is the top of the balance range. We're in a balance range in a longer time frame, meaning a short off this level is very probable. Now, if ES respects 56.30 and NQ 19.815 as a resistance, this could sell off into 56.10 and 19.685. I do this every single day, right? So this was a setup. Let's move this a little more. 4 hour was bullish, 30-minute was bullish, 5-minute was bullish. So this was actually, okay, I remember this. This was an A- setup. Why? Because I was going against the overall condition and the overall trend. So what do I do when an A- setup presents itself? I just size down. I'm not going to not take it. If it's a setup, it's a good setup. If it's against the trend, I size down. So I went for a supply bounce, right? Consolidated in supply, volume died off. This is what the footprint chart looks like, right? Let's go ahead and look at volume first. Dead volume on the wicks from my entry, right? Every time we approach those new highs in supply, we had dead volume on the wicks. Super important factor for me. Most of the volume on these candles on the lower end, so it means there was more interest in price, more interest in transactions at the lower end of this consolidation range, which usually means the lower or the sell side is a little stronger. And then we also saw decreasing volume right into supply, which is a big tick for me. My entry trigger was a 3 dead volume wicks, which is a huge trigger for me that I use a lot. It's a decent win rate. I have some videos on this in the Discord, everywhere. Actually, I have some videos on it. So one of the triggers, everything made sense. I took it with small size. So another entry trigger here. You got 2K with the big buyer on top for absorption, right? So this is another kind of thing you could use to make this play an extra confluence, basically. You have a 1.4K right here. You have 1.5K right here. You have big buyers at the top with dead volume above them, so exhaustion, and price refuses to move up. So it's a pretty simple setup here. What was my exit, right? Due to VWAP and this is the new low being far away, I use Bookmap, right? I use Bookmap to find any major orders as a TP because VWAP was kind of far for this, and I do scalp a lot, so Bookmap is what I use. And I think, let's see, yeah, it was these offers here that I used to get out. So the risk, right? I risked 3.5 points. Let me go back here and see what the hell. Okay. So I risked 3.5 points to make 10 points, right, on the first take profit. And sometimes I have multiple take profit levels. So keep this in mind. If I was trading one contract on the ES, right, I would be risking $175 to make $500 with one contract, which is an R multiple of 2.86. Try to keep my R multiple around 2. For me, it makes the most sense for my win rate. Recap, right? Overall, good trade, even though it was A-. We followed the pre-market plan and had great risk, and we made money, right? Even though we sized down, that's according to what we have to do for A- setups. Trade 2. Oh, this was a little bit further last year, and this was on NQ. Beautiful trade on NQ. I actually do remember this one. Pre-market plan was to go long. So I went against my plan here, right? Against my plan because sometimes, especially when we have aggressive movements in the market after the open, my plan will change. And that only happens if I see aggressiveness on the open. Usually I go for a follow-through, aggressive continuation. And for this, I need around 2,000 delta on the open on the ES or the around 2,000 on the NQ as well, with them following through and not getting absorbed. So this was the setup. It was bullish market structure, right? In major supply, close to VPOC, should have waited, and it was small size, but overall bad trade, right? And this, I think this was a loss, if I remember correctly. So my entry trigger on this, right, was big seller hopping in after we filled a big sell offer. So we filled a big sell offer right here. We had some exhaustion from buyers, and then huge sellers hopped into the market, right? And that's when I was looking for my entry. This was a false range breakout play as well, which was my entry trigger. The risk, right? I got 1 point away from my take profit because it was going to be a little scalp, and ended up getting out at, this is a break-even trade. So 1 point from TP and ended up getting out break-even. So we saw dead volume, did not fill the buy side imbalance, and we saw dead volume on the wick, and we saw a reversal sell side imbalance, didn't fill the buy side, reversal sell side with dead volume. So after I saw this at a level where price could reverse, if it's too close to my TP, well, it got super close to my TP, I go ahead and move my stop to break even. So I risk $290 for this trade to make $500. And this setup has an over 60% win rate because of the Bookmap, because of these offers getting filled in exhaustion with big sellers hopping right away. Super, super high win rate if that happens. So, really close to 2 R&R, but the setup has an over 60% win rate, so not 100% necessary. But to recap it, right, we went against the overall structure, right? We did not stick with the plan, and it was a good exit at break even, so at least we got out break even, getting close to 11:30, which is around my cutoff time. So why, again, did we have a break even exit, right? Add reaction off imbalances and a reversal imbalance, right? And seller at the bottom of the candle, not moving price down. So if you want to stick to the end of this video, I will do an educational webinar kind of on imbalances on footprint charts, which are key. Love imbalances, trade them a lot. They're very, very, very useful. So the next trade we're going to go over here, right? And this was NQ short. This is in August as well when I made this PowerPoint. And part of the pre-market plan, right? Balanced market was looking for both sides. So buyers for the day, we were in a balanced market opening in a similar price level from yesterday. I'm interested in playing the top longs or the bottom, or playing longs at the bottom of the range at 56.15 on the ES right here, and 96 or 19.785 on the NQ right here. So I'll also be looking for a reaction at the top of the balance range where ES is opening now, and on NQ it's 19.970 up here. We had a lot of seller interest yesterday, which we did. You can tell from the move yesterday, and it looks like to me we could drop off later when we have data. So we had data that week. So what was the setup? Supply bounce with consolidation, right? Increasing volume, but we had lots of absorption. So we had a little bit of increasing volume on supply, but a lot of that was buy side absorption. And we're in a balanced market, so I was okay with playing both sides. Entry trigger, right? Failure to fill imbalances with dead volume, buyer absorption at the top, right? With new sell orders coming through, so very similar to the last trade, right? And then we had aggressive follow through, filling these offers and actually price holding below, filling buy offers, price holding below, buyers getting absorbed, right? You see these buyers fill sell offers, not go above. Then you see aggressive sellers come in, fill buy offers. Sorry, these buyers do not fill sell offers. You see sellers come in and fill buy offers and hold below. So a lot of things made sense here. You see absorption. So it was a very, very good setup. The entry trigger here was dead volume on the candles plus the big this is the big buyer at around 10. So this was on the what was this on the Qs. Okay, yeah. So you're looking for some smaller volume on the Qs, which makes sense. Dead volume on the wicks and the buy side absorption on the Bookmap as well that we saw. Decent setup, very, very decent setup. My exit was a floor, right? The floor we saw sellers absorbed and buyers hold on. So a very, very good trade here. The risk, so for this trade, we risked about 16 points, which is 320 to make 900, and our multiple of 2.8. So it was a good trade, right? So we did go against the major trend, but shorter time frame, we were in a balanced range. And aggressive follow through allowed us to secure a higher payout, allowed us to hold longer and actually make a decent payout.
And before you guys leave off, I want to leave you with a couple things. I have a list here of a couple things that I want to talk about that I wish I would have heard, that I wish I would have known before I got deep into trading. So I'm going to start right off by honestly, we're just going to make them random. We're just going to break them down randomly. All these things will probably help you. The first issue is going to be mostly to deal with psychology, and we're going to talk about that a lot, is a lot of your issues come from fear, greed, FOMO, all of this shit, and a lot of it could be solved, especially revenge trading, oversizing, getting emotional during trades, can be solved by reducing size. You reduce your size when you're stressed. You reduce your size when you're scared. You reduce your size when you have greed, when you have FOMO, when you feel any kind of emotion sneaking up into your brain. You want to reduce size because that will affect the way you execute. And having smaller size makes you care less about the losses while still potentially having the ability to make some gains. So reducing size will solve fear, will solve FOMO. It will solve all these issues because if you're risking less money on a trade, you won't care about the losses. You'll care less about the trade because if it loses, if it goes against you, it won't be that much money. Now, the next thing on the list I have here, and this is actually pretty important, it's all going to be kind of random, is not to trade alone. Don't trade by yourself. Be in a group, be in a community. There's plenty of free communities out there. I have a free community. I'll link down below in the description. There is so many resources out there, so many groups, so many activities you can do to just not be alone in this process. Because trust me, I started this process alone. I was alone for a majority of it, and it is a dark place. Nobody will understand you. Your parents will think you're gambling. Your friends will think it's a scam. Your girlfriend will think you're a nerd. Everybody is going to leave you alone. Nobody's going to understand what you're going through and what you want to do, because it's kind of impossible to them. Just think about it. Just the concept of going in front of a computer screen, pressing a couple buttons, and making life-changing amount of money is absurd to anybody. If you were to tell me that before I knew what trading was, I would have thought you were fucking scamming. I would have thought you were gambling. I would have thought something crazy would actually be happening. So please, guys, for the love of God, join a community. Start trading with your friend, right? Maybe a couple of your buddies can start trading with you. Y'all can start making money together. Y'all can improve your lives together. And trading is not just about the charts. Your success is not just going to be based on what you do on the charts, but what you do off the charts matters significantly. Do you maintain a healthy diet? Do you exercise? Do you have good relationships with the people around you? All of these things are going to play a huge factor in whether you perform well on the charts. If I'm going through something in my life, if somebody passes away, if I'm going through a tough time, if your girlfriend breaks up with you, don't trade until you're in the right headspace, because not only will that affect your execution, but it will affect what you do after you lose. Those kind of things will hang around with you as you're looking at the chart. So don't trade distracted. Don't trade after your girlfriend breaks up with you because you're spending too much time on the charts. You don't need her anyway. Just trust me, right? Trust me. If you're going through something, don't trade. What you do off the charts matter. Exercise, maintain a healthy diet. Your mental health is super, super important, man. I'm gonna tell you a story about me when I first started trading. I got to the point where I was so bad when I went to the doctor, right, figure out what was wrong with me. This is before I was, on my health grind. They put me on antidepressants before I was against medication, right? Not all medication, most medications. They put me on antidepressants, and these medicine have crazy side effects. And one of the side effects of these antidepressants were suicidal tendencies. And I was at a point very, very close to it. I don't even feel comfortable talking about where I was in life, but I feel like I need to, just so none of y'all actually get to that spot. It can be dark and it can be lonely if you don't take care of yourself, if you don't take care of your mental health. Prioritize your mental health, prioritize your physical health, right? What you do off the charts will matter. Trust me, money is useless if you have shitty mental health and you're depressed and you're anxious and you're sad, you have nobody around you. Money is useless. Money will not make you happy. And I know you probably hear that all the time from people who have money, but trust me, I came from a place where I had no money. And now I'm where I am right now with all the money I could possibly need. And it does not make you happy. It will not buy you happiness. So if you're sad, poor, you're gonna be sad while you have money. So please promise me that you only get one thing from this 3-hour-long video, is that you will prioritize your mental health and you'll prioritize your physical health while you learn to trade. Because if you have shitty mental health and physical health, you probably won't make it as a trader anyways. Let's move on to the next topic. So something that's pretty important too is people are trying to win too fast. You try to make money right now. You're not gonna fucking make money today if you just start trading. Next year, fuck it. You're not gonna make money if you start trading today by next year, right? It's a fucking long, brutal learning process. People go to college for 4 years to get a fucking degree, for the opportunity to get a high-paying job, even though it's fucking bullshit in this day and age, right? People go to fucking college for school for 8 years to be a doctor, 6 years to be a lawyer, just because they expect to get paid high amounts of money. So trading should not be looked at any differently. You're learning a high-income skill. Why the fuck do you think you're gonna learn that high-income skill in any less time than it takes you to become a doctor? Right? You're not gonna fucking learn a trade in 1 month, be fucking rich. It's not gonna happen. Get rid of that expectation. It's gonna take you a long fucking time and you're gonna go through a lot of pain and a lot of fucking struggle, and eventually you might end up getting to where I am today. And honestly, you will end up getting to where I am today, or if not even better, if you don't quit, if you don't give up. It's impossible for you to fail. You're gonna lose a lot, but you're gonna learn from every single loss. And if you just don't give up, you will not lose. You will not fail. You will make money in the end. The next one here is going to be, oh yeah, this is a fucking big one. Everybody loves to hop around from strategy to strategy because they have FOMO. They don't want to miss out. They see people making money with this strategy and the market conditions are good for that strategy, so they hop on over. And then when the market conditions switch, they switch to a different strategy. Those people are never profitable. They'll never be profitable. The reality is there's hundreds of strategies that work on the market. There's so many. All of them work, and the market is a game about probability. It's a game about numbers. It's a game about stacking the odds in your favor, and then it's a game about having enough numbers, enough trades, enough of a sample size that luck gets removed from the equation. So what you have to do right, is pick one strategy that works for you, backtest it, know it's legit, know it works, and don't do anything else. Trade that strategy every single day for the rest of your life. So what, you'll have losing weeks. So what, you'll have bad streaks. That's the same thing with every strategy. But if every time you have a bad streak, you go looking for something else, the numbers will never work out in your favor. The numbers will never be right. They'll never be legit, and you'll never make money in the long run. Sure, you might make a little, couple $100 here and there, a couple $1,000 here and there, but this is a long-term game. You want trading to replace your income, right? You want it to be sustainable. What you need to do is find one thing, figure out what that one thing is, define consistency, figure out the win rate, figure out your risk reward ratio every single trade, figure out how to execute flawlessly, protect your risk, right? Learn how to manage your emotions with that all based on that one strategy, and then money will become a byproduct. You will make money in the long run. Don't think of money in trading as a span of one trade or two trades or three trades. Money from trading comes in the span of 100 trades, 200 trades. That's when you'll see money from trading, because again, it's all probability, right? You can flip a coin 100 times, it can fucking all be heads. You flip that shit 10,000 times, it will never ever all be heads. It'll be closer to 50-50. The more you spin it, the closer to 50-50 it will be. That's how you should look at trading. Another thing that really, really helps most people, and this is how I've seen people turn honestly profitable super fast. I have some people that I've personally mentored. I'll put them on the screen here. I'll put their testimonials in the description as well. I'm not mentoring anybody right now. It honestly takes up a lot of my time. But these people are the ones who have actually seen the fastest rise I've seen in profitability, just because you're learning from somebody who's already where you want to be. So find a mentor, right? If it's not me, if it's not through my YouTube videos, fucking find a mentor and learn directly from them. And that's the fastest way to fast track your way to profitability. Did I do that? No. And it took me 3 years. 3 years to make money trading. Not a lot of money, 3 years to actually become profitable trading. I started making a lot of money a little bit after that. Now, with that being said, if I were to have a mentor, would it have taken me 3 years? Fuck no, probably would have taken me a year, maybe even less than that. So just keep that in mind. If you want to fast track your way to profitability, find somebody who can mentor you, find somebody who can guide you to where you want to be. If they're, and the best way to figure out if they're legit is, are they where you want to be 10 years in the future? And if that's a yes, that's all pretty much you need. Now, let's move on to the next one. Also before I forget, we'll have in the description below, those of y'all that are more like visual, y'all like to read things, I'll put the full in-depth course. Basically everything I just talked about here, but we also have a prop firm course, we'll have a psychology course, taxes as a trader course, and everything we just mentioned here. The whole PowerPoint will be in there in the description below. It's all free, just more PDFs, more things you can read. It's just much more easier to track if you want to do it that way. It will be linked in the description below. There's also a prop firm course in there, and y'all should definitely take advantage of prop firms. A pathway for trading should be learn how to use the software on a demo account. Once you learn how to use the software, you transition into a prop account, right? An account where you pay a fee, right? If you don't know what a prop firm account is, basically, I'll link down in the description the best prop firms in my opinion, but basically what a prop firm is, right, is you have the ability, so you pay a prop firm, let's Top Step for example, or Peak Funding for example, you pay them $50. They give you an evaluation account, which is a demo account of $50,000. You have a profit target, which is usually around $3,000, and a stop loss or a drawdown of $2,000, meaning you have to make $3,000 before you lose $2,000. And if you do so, you will pass the evaluation account. You'll be given a funded account of $50,000. Now, that $50,000 is not yours to keep, but any and every money you make from that $50,000 then becomes yours to keep. So you can trade at 50K, all the profits you get are yours to keep, and you can withdraw and put them into your bank account. So if you don't have money to start trading, all you need is $50. You don't need money to start trading anymore. The times have changed completely. So take advantage of prop firm accounts, and once you have enough payouts from those prop firm accounts, your next goal should be to dump all that money into a live, real account that you're going to trade with your own money, no rules, no bullshit, that you're gonna have, and it's gonna be yours, and you're gonna grow and grow and grow and grow. And something that's very important, this is the next topic, is identifying psychological triggers. So we're just hopping all around the place here, but I have noticed that so many traders, so many traders are so good at winning. They have really good win streaks. They can take wins like no one else. They take wins, they take wins, they take wins, they take wins, and they have one day or one streak that loses weeks or months worth of progress because they go on tilt. This is why I have to track and journal everything, because you'll start to pick up on these little triggers, right? Whether it's you get stopped out, ticked out, and it goes straight to TP, whether it's you miss a setup because you're distracted, whether it misses your TP by a point so you chase. These triggers will cause you to blow months and weeks worth of progress if you're not able to identify them in real time. The way you do this is by tracking your progress, and you look, oh, all these days of tilt started with one little thing happening. Maybe you got distracted, maybe it wicked you out before going to take profit. It will be such a common occurrence, it'll be super obvious to pick up on, and when that does happen, right, all you have to do then is add in a rule. If I get wicked out when it goes to TP on my first trade, I'm fucking going for a walk and I'm coming back and dropping size, or I'm done trading for the day. You do that, you make it impossible to blow weeks and months worth of progress in a single trading day. Next one we have on here is stop. I mean, I can't even, I have to say this, but you have to stop being scared of being wrong, right? Stop being scared of losing. Trading is a game about losing, and you're gonna lose over and over and over and over and over. I lose every single week. I lose all the time. Trading is about losing. It doesn't matter how good you can win. If you can't fucking lose, you'll never make money trading. So don't be scared of being wrong, because you're gonna be wrong. No trader is right 100% of the time. The only thing that's gonna matter is how you manage your risk when you're wrong, is how you're able to walk away when you're wrong, is how you're able to actually stop out when you're wrong, right? That's what's gonna matter. The next one is here, super important one is not being scared of missing out. So I mean, I'm in a trading community, multiple trading communities. I talk to people all the time, and there's some people when they're trading different setups than me, trade different strategies, and I see them fucking making a profit, they're making bangers while I'm sitting there on my hands. Oh, it's a no trade, I didn't see a setup. I don't care. I know my strategy, I know my setup, I know what works for me. What other people are doing could fucking mean less to me, right? I don't really care, right? They're making money, great. I'm making money, good. We don't have to make money every single day, right? Don't have the fear of missing out. The market will always be there tomorrow. The market will be there next week. The market is not going anywhere. So just because someone else is making money today, it doesn't mean it's your day to also make money. Don't have FOMO. It will kill your account. It will cause you to chase. It will blow your account. Remember, the market will always be there, and wait for your setup. Cherry pick your setup every single day. The next thing we have going on here is, I'm probably going to end it off with this. There's so many things I can talk about here, to be honest with you guys, and I don't want to keep y'all here for too long. Y'all have been here for like 2-3 hours. If you've been here through the whole video, comment down below the word pepperoni pizza, and I'll hook you up with a little something. Just stuff I know and y'all been here the whole time. But look, your only goal every single day should be to follow your rules. You don't set any monetary goal, don't set any dollar goal, don't set anything else other than to follow your rules. No weekly goals, no monthly goals, no yearly goals. I don't give a fuck. The market's not linear. It's not always going to be giving you opportunities, so you don't even think about the monetary goals, because they will just slow you down. They will piss you off, right? So don't set any goals except for following your rules. Write down what your rules are, your trade limits, right? Your maximum loss limits, what you have to do to size down, your entry triggers, all that shit, and make it your daily goal. Tattoo this on your arm. Follow my rules. Today, my goal will be to follow my rules. Tomorrow, my goal will be to follow my rules. And if you are actually able to do that, money will then be a byproduct. You will make a lot of money in return just from your discipline of following your rules. So leaving it off with that. If y'all enjoyed this video, I know it was super long. Hopefully it gave you everything you need to start your journey, or just continue your journey, or make money in this whole crazy trading process. Make sure you leave a comment down below if you enjoyed this video, or if you have any questions that you want to ask me. I'll get to you as soon as I see the comment. Without further ado, guys, again, I appreciate y'all more than you know. I'll see y'all next time.